All right. Just in case, again, I happen to say something that someone wants to watch again. You don't have to, it's not lost to time. Calvin, love you, dude. Yeah. Let's see, JS. Is there a way around pattern day trading rules using options stocks? Yeah, you could simply day trade SPY one time every Monday, Wednesday, and Friday, and you would stay outside the pattern day trading rule. You could do swing trades. You could trade a cash account. The problem with a cash account is you can't sell options in a cash account. It has to be a margin account. So at least that's true with most brokers. So you could still day trade that. Another issue with cash accounts is it's going to take about a day or two for your cash to settle. So you won't get your actual profits for a couple days. But here's another myth with pattern day trading rules, okay? Sorry, my throat's freaking out already. All right. I make more money on everything outside of day trading. Day trading, I make good money. But I make more money outside of my day trades than I do with day trading. So I think everyone kind of sees the YouTube stuff. They see everything. They go, all right, wow, like if I want to be rich, I got to day trade. Not true. So you've got to think about each strategy is just a tool in your toolbox. Okay. So today, did it make more sense to day trade than it did swing trade? Sure. I actually got into a swing trade today as well. Right. There's just certain times where things would make more sense. And today was just a great time to day trade, in my opinion. Doesn't mean that I day trade very often, not very often, maybe a couple times a week. If the setup is there, there's some times where I don't day trade at all. And there's sometimes where I day trade 5 times a day. It just depends on the setup, right? There's not some rule to it of what I do or what I don't do. So don't feel like day trading is your only way to make money. If you have $500 in your trading account and you're like, man, pattern day trading rule just messes with me so bad, you're focusing on the wrong thing. Strategies are not going to make you rich. No. Let me explain. Understanding and diagnosing the solution to the markets is what will make you rich. Your strategy is simply the tool that you use to apply to make you that money. So, what do I mean by that? Let's go to a bigger time frame. If you can understand how the markets move, right here, in my opinion, I feel like we are going to be going bearish. That's why I got some bear swing trades today. We will be going bearish. Why are we going bearish? Why? Because I know how the markets move. Is there a chance it goes more bullish? Of course. I've got a game plan if that happens. And if it does, it doesn't change the fact that we're still in this part one. The next step is going to be a pullback and then probably back up. We'll see, because I also think that on a bigger time frame, we're getting ready to drop pretty hard. We'll see if that plays out, but I believe that's about to happen. Whenever you're looking at fixing a car, you don't go, all right, give me a 1/2-inch socket, and you crawl into the car. No, you go under the car, you figure out what the issue is, and then you get the tool that's going to fix the issue, right? Everyone takes trading like, all right, I've got this strategy, and this strategy is what's going to fix my problem right here. No, the strategy works when you apply it, when you diagnose the market and go, all right, I could have the greatest bull strategy in the world, and if I keep doing it in a bear market, I'm going to get crushed. Vice versa. I get the greatest bear strategy. So what's better? Figuring out if the markets are bullish and bearish, and then picking out of your toolbox which strategy is going to make you the most money in this situation. Does that make sense? That kind of help? So just changing the way you think in your perspective is so powerful. You don't have to day trade to make money. Does day trading make a lot of money? Of course. But so does swing trading, and so does option selling, and so does everything else. It's just pick your poison, right? Whatever tool you want to use that's going to solve that problem is probably the way to go. So I'll explain to you about Amazon. All right. Amazon, I got into a bear swing trade today. Whoa. Not really sure what went down with that, but let's move that. There we go. Medication and psychiatrist is a solution. Oh, man. It's the truth. But hey, good point, though. Just invest in yourself. Instead of having a $500 R and losing all your money, take that $500, invest it into coaching, have a $20 R in the meantime, and learn the skills, gain the tools so that when you learn how to, first off, my first go-to is diagnose the market. Where the heck is this thing going to go? And then what do I do if I'm wrong? What's my game plan if I'm wrong, right? I don't focus on how much money I can make. I focus on how much money am I going to lose. How can I control my losses? Because when all is said and done, this is all simply a game of math. That's it. You've got a 50-50 shot. Flip a coin, 50-50. The only way to make money flipping a coin, right? Woodshed, if I give this example all the time, if I paid you $1,000 every time it lands on heads and you paid me $400 every time it lands on tails, would you do those odds? Yeah. Woodshed said no. Should have used someone else. Rock, let's use you. Of course. Will there be times where it lands on tails 3 or 4 times in a row? Of course. Will there be times where it lands on heads 3 or 4 times in a row? Of course. But odds are it's pretty much a 50-50. Law of averages, just flip the coin 1,000 times and you're going to walk out ahead, right? So what are even better returns on that? An even better return on that would be you make $1,000 on heads and lose $200 on tails. The exact same thing. You're flipping the coin the exact same way, but you just completely changed your return. That's all trading is, my friends. That's it. It doesn't matter if you win or if you lose. Doesn't matter. Flip a coin. I'm either going to win on this trade on Amazon, and I'll show you what it is. I'm either going to win on this trade on Amazon or I'm not. What is in my control? How much I lose and how much I make. So when I'm up $500 right here, and I'm like, oh my gosh, I'm up $500 in 25 minutes. Should I take it? Well, I don't know. What does the math tell me? The math tells me I need to win big and I need to lose small. Does it help me at all if I make $500 on heads and lose $400 on tails? Not really, kind of. What helps me a lot more? Making $1,000 on heads and losing $400 on tails. So does it help me to pull the trigger and take my money too early on this trade? No. Does it help me to go, well, it's losing on this trade. Let me just see if it'll turn around. Let me pray it turns around. Oh my gosh, I'm down $1,000. Okay. Well, now I'm down 1,000. It's going to turn around. Now you're down $2,000. Well, it's bound to turn around now. Now you're down $3,000. And then what are you doing in that scenario? You are now screwing with your math. You went from losing $400 on tails to losing $3,000 on tails and making $500 on heads, right? This is the reason why most people struggle in trading. Who gives a crap if you win or lose? It doesn't matter. You can't control that. No matter how hard I want Amazon to go down a little bit right now, I can't do anything about that. What can I do? I can have a whole toolbox full of strategies, then I can apply the best strategy to it. Strategy that meets my needs, my lifestyle, and what I'm expecting to get. Pull that strategy out, put it in there, and the next thing I can control is making sure I lose small and making sure I win big. Holy crap, trading's so easy, isn't it? Oh man, staring at every 3-minute candle doesn't make you go away. Yeah, that's all there is to it. Accept the stupid loss. Understand that if I can just do my best to lose small and do my best to win big, that's all that matters. Quit taking your money as soon as you're green and quit letting these losers run forever. Manage your math. Put the math in your favor and stop caring and weighing your emotions and weighing your self-worth on every single stupid trade. My friends, you're not smarter because you won on a trade, and you're not dumber because you lost on a trade. That's stupid. That's like me flipping a coin and it lands on heads, be like, I knew it. I knew that was going to land on heads. Man, I'm the smartest person in the world. Then I flip a coin again, like it's going to land on heads, and it lands on tails. No, oh my gosh, I'm such an idiot. How am I so stupid? Again, that never makes, we all look at that and be like, of course, it's just flipping a coin, dude. You can't, either you're going to land on heads or you're going to land on tails, dude. But yet we do that in the markets on every freaking trade. We lose twice and we're like, okay, screw that. That strategy's gone. Let me go get another one that's going to make me rich. It doesn't work. Trust me, I did it for months. I blew up account after account after account. I didn't know what the heck I was doing. Well, the coin must be wrong. Let me go get a smaller coin that might give me a better odds. Oh, no, not smaller. Let me get a bigger coin now. That one, a quarter, will definitely make me land on heads more often. Just, my friends, play the math. Play the math. So let's dive real quick into what this Amazon trade is, because I still think it's a viable trade if you guys want it. Will it work? I have no idea. Flip a dumb coin. What can you do? Risk the amount you're okay to lose and let the stupid thing win. That's what you can do, right? Is this one trade going to change your life? No. If it is, you're putting way too much money on it. That's not how you trade. So first off, another thing too, if you're trying to get rich quick, you will only lose money. That's it. Jeff, yeah, I can talk about some weekly credit spreads for sure. If you are trying to make 1% of your account a week, you will be a millionaire. It's just a matter of time. That's what the markets reward. You're putting a risk on where it's not going to hurt you. You really shouldn't care enough on this trade. You really shouldn't. Whatever amount you're willing to give to a homeless person in the street is what your R should be. It's like everyone's willing to donate $3 to some homeless person, but they're not. And then they have a $500 R. And I'm like, why? Clearly you care too much. He's like, but it'd be amazing if I make $500. Yeah, but what happens when you lose 500? Clearly you're not okay to lose that. Now, if you have a $100,000 trading account, you could justify and say, look, it doesn't matter if I'm okay with it. I follow my plan, I follow the math, and it's less than 1% of my account. Done. Sold me. 1% of your account is where you should be at trading, and honestly be way less than that starting out. There's no point. You're the worst trader you're ever going to be today. Tomorrow, you're going to be a little bit better. Why put all the money on today when you're suck? When you suck, what's the point of trying to get rich? You're not going to. You're just going to lose. So when you're first starting out, you probably have about a 30 or 40% win rate. And you add on top of that you're screwing with the math. You're probably losing big and winning small, which is doubling down on how fast you're losing your money. Once you can finally start to understand how to trade, you will be about a 50-50 win rate. So now people that are stuck in break-even mode are the ones that keep losing big and then keep winning big, so you never go anywhere. $1,000 loss on tails, $1,000 win on heads. You're not going anywhere. Or you're doing really good at losing small, but you keep doing really good at losing small, but you keep winning small as well. You've got to put the math in your favor. That's the only thing that's going to separate you getting ahead. Then when you start to read the markets, now you can start to push that win rate even higher. And now you're doing the opposite as before. You're having a higher win rate, probably 55 to 60%. And you're adding the math in your favor of you're able to win really big and lose really small. And that's where the money just starts cranking. But it takes a long time to get there. It's a long path. Okay. Let me go over this trade on Amazon. All right. So if we look at a weekly chart, we broke a very key support, crushed below it. What's most likely going to happen? We are most likely going to bounce back up, retest, and roll back down. Most likely what's going to happen. Where is that retest going to happen? Probably back into this resistance, right? Now old support, new resistance. So I figured I'd dabble in with some puts here. I bought puts that expire. What are they? September 16th, 134 strike puts. So I bought the 134 strike, just barely out of the money. I bought those when the price was up here into the 200. So I think the price was about right there. I bought those puts. Within 45 minutes, I was already up about 40% of the value of those puts. It's crazy. You can leverage options. If you're getting in, everyone else is getting out of their puts, right? They bought puts here, big gap up. It'll go lower, it'll go lower, it'll go lower. And they finally go, I've had enough. That's where I'm buying the put. They're giving it away. All right. They're just giving me their put. They bought it for $20 and they're going to sell it to me for $4. They're going to take a massive loss. I'm getting in and I just doubled my money almost within hours. Crazy is that. If you just, again, I'll go over that a little bit later today. And if not, later on this week, we'll talk about that because I'm on the mic quite a few times this week. Check out reallifetrading.com. Look at the agenda. It's there for everyone. You'll see when I'm on. Options hour for, oh, really, it's an hour and a half. Okay. So I bought these puts for dirt cheap because everyone was getting the heck out of puts. It looks so bullish, and it is bullish. So why the heck am I thinking this is going to go down? Why? Because price action. Reading markets, reading charts, realizing this is extended, realizing if I go to a 1 hour chart and I turn off the extended hours, doesn't matter, extended hours on, extended hours off, boom, this is where the bulls are no longer correct. And so on a pullback, everyone's like, oh my gosh, we're no longer bullish anymore. Guess what I'm doing down here? I'm buying long-term stuff, shares, calls, options, 125 to 126, perfect spot to do it. So I think we're going to be pulling back. And the cool thing is I was able to buy this right at a resistance. So now my stop can go right there. My friends, I'm not going to lose on this trade. I am not going to lose on this trade. It's a free trade now. Easy, right? If you can get in at the right entries, trading is easy. If you're constantly buying puts down here when you shouldn't be, trading is very hard. Stressful, losing. I lose, but I know how to lose $200 and I know how to make $5,000. I risk $300 to make $5,000, right? That's my risk reward. Everyone else's is, oh, it's going to go down. They put $1,000 worth of puts. They get their butts kicked. But when they're up, they take their $50 win. They're doing the opposite with the math, right? So I think this is still a viable place to buy some puts. Will this trade work? I don't know. But I got them at a place where I'm not going to lose on these. I've taken a little bit of profit here. So I actually went pretty heavy up here. I was able to get out of those extra puts for a win. And those extra puts just pretty much paid for this entire trade. And I've got my alert there. If we do go higher, I'll X out of the rest. Boom. I locked in a guaranteed win. And I think Amazon's probably pulling back down to 130 to 128. So I'll exit out of those puts there. And then I'm doing what? Getting ready to buy some longer term calls. Ride this thing back up. What's telling me to do that? Price action. So I have in my toolbox, I have multiple strategies that I could do this here. I could have day traded this, which I did not, but I could have. I could have day traded that and made my money. I could swing trade it, which I did. Or I could do a credit spread. So I could sell a credit spread. What the heck is a credit spread? A credit spread in simplest terms, I would have sold it up here. The reason why I did not is because it didn't pay me anything to sell up there, which kind of sucked because I would have done that in a heartbeat. A credit spread is a trading strategy where it gives you a massive cushion to be wrong. Credit spreads, you don't have to be perfectly correct. You just have to not be dead wrong. So if you're kind of right, so what if I sold a credit spread here and I need this thing to go down to win and it kind of does this? Excellent. I still win. Still going to make all my money. As long as it stays below my short strike that I sold, I win. So the cool thing about credit spreads is right now, it's like, cool. Do I know that this is going to go down? No, it's looking pretty good. But if I sold a credit spread up here, that would have paid enough, I would have done it. I could still make money if it goes down, if it goes sideways, or if it goes up. That's why I have a 90% win rate with my credit spreads, because I don't have to be perfectly correct. I just have to not be dead wrong. The only way I lose is if it does that. So if it does that, what can I do? I can hedge against it. I can turn this losing trade back into a winning trade. Again, I have a whole class to teach you how to do all this stuff. If you guys want to know, hit me up, email me, Tony@reallifetrading.com. I'll walk you through it. Find that on reallifetrading.com's website as well. So why credit spreads and not debit spreads? So a debit spread is still a directional trade. So if you buy a put and sell a put down here, it still has to work. You have to be perfectly correct. It has to go lower for you to make money. If it goes up, you lose. If you sell a credit spread, meaning I'm selling a call and I'm buying a call, I win as long as it stays below this. So it can go up, it can go sideways, it can go down, and I win on all of those scenarios. A debit spread only wins on the down scenario. And then you only win the most you can make if it gets all the way down to your target. Credit spreads, I make my max profit as long as it stays below this by expiration. So if I sold this thing 2 weeks out, as long as it kind of hangs out for a day, I win. Because it's going to lose that much value. The people that bought calls, I'm selling calls to people. Remember, calls go up. So if I sold that call, whenever you bought, someone spent, $10,000 on calls right here on Amazon. So if I sold them those calls, I made $10,000. That money's in my trading account right now. Boom. Now I have a contract, an obligation to fulfill whatever obligation I sell, which in this case would be to sell, 10 contracts, 1,000 shares of Amazon. Do I need to own 1,000 shares of Amazon? No, I don't. Why? Because I bought my own insurance. So I sold some insurance, so to say, easiest way to say it. And I bought my own. I bought calls up here higher above it. So if I got paid, again, just for easy math, if I got paid $1,000 to sell this call, and then I turned around and spent $500 for my own insurance, I have a net profit of $500 and I am fully protected. If I lose on this and it goes higher, I can just exercise my insurance if I get exercise on my short. And the worst thing that can happen is I lose the difference between those two. That's it. Cool. So that's the difference between credit spread. And that's what I'm saying. If you can just read the markets, I know this thing's going to head down. And if it goes a little higher, that's fine. It's still going to head down afterwards. But that's the question mark, right? I can make, well, first off, there's pros and cons to every strategy. With credit spreads, I can only make whatever I get paid. So my max profit, let's say, is $1,000. That's what I got paid. So it doesn't matter if Amazon goes all the way down to 110, I can still only make $1,000. But I get a 90% win rate doing it. And $1,000 isn't anything to cry about, right? In one trade. Who would take $1,000 trade right now? Type in a 1. I think we'd get a few ones out there. We got a couple ones. $1,000 trade. Done, right? So that's one tool in your toolbox. Credit spread. It's not going to make you the most money, but it's the most consistent way to make money. And if you're not quite sure that this is the exact location it's going to go down, credit spreads are awesome because you can have a huge cushion to be wrong and still make $1,000. Boom. Awesome. I love credit spreads. I pay my bills all the time with credit spreads. They're fantastic. I love them. Put it in your toolbox. Learn how to do them. Another thing in your toolbox could be a swing trade. What's the downside with a swing trade? I have to be perfectly correct if I take a directional trade. Now, what's the upside with a swing trade? I can make a lot more money than just $1,000. Like I don't have a cap necessarily. I mean, technically it's $0 if the stock gets to 0. But I can make a lot more, right? If Amazon gets down to here, I'll be up $5,000. So yes, I have to be perfectly correct on my timing, but I can make a lot more money. Whereas if Amazon went to here with the credit spread, I'm still only gonna make $1,000, which is cool. It's fantastic. But if I get my timing perfectly right, I'll make $5,000. All right. Lots of questions coming in. So let me jump on those. Credit spreads versus iron condors. Iron condors is when you do 2 credit spreads at the same time. It's the easiest way to think about it. So you sold a bear call spread up here, meaning you win as long as it stays below this line. And you sell a bull put spread down here, meaning you win as long as it stays above that line. The problem with credit spread or iron condors that I don't like is it's a pure theta game. As the price goes down, this one wins, but this one loses. As the price goes up, this one wins, but this one loses. And so you have to wait pretty much until close to expiration to make your money. Okay. I prefer personally credit spreads. because in a credit spread, I can be in and out in days. And I don't have to wait till expiration, so to say, with an iron condor. Yes, you can make more money with an iron condor, but it's also easier to lose on an iron condor, because what if Amazon what if Amazon pulls down and then starts to just rampage? I'm going to lose more money on this than this credit spread's going to make me. So now you have double the chance of losing. Now you're just literally praying it doesn't go outside this range by expiration. And the problem is, if you're going to sell this thing, well, it's like, well, cool, I'll just do 2 weeks till expiration. That means you have to do an iron condor here and here. That's all you can get paid for. So now what are the odds Amazon stays in this circle within 2 weeks? It's possible, but I would much rather just sell a bear call spread, hedge it if it goes against me so I can turn that loser into a winner, and be able to make money on the way down on this, pick a direction, using the markets to tell me which direction it's trying to go. Again, that's the key. That's the key point. Understand how to diagnose these markets. If you can't do that, it doesn't matter. It doesn't matter what strategy. You'll lose all the time on credit spreads. Whereas I have a 90% win rate, you'll have a 10% win rate. Because if you keep doing bear call spreads when the market's bullish, you'll keep losing. If you keep doing bull put spreads when the markets are going lower, you'll keep losing. It doesn't matter. You've got to be able to diagnose the markets. And then you go to your toolbox and figure out pros and cons of each one and which one you want to use. Make sense? So for me, iron condors are fine, but I really prefer credit spreads because I can leverage my money. I can take that money, win in 2 days, and get into another one. And by the time that one iron condor is finally over with, I've probably done 4 credit spreads that have made me 4 times the amount of money that this iron condor would have made me. Can't talk. That's just me personally. So that's my 2 cents on that. Jeff says more capital out at first. Yeah, so that brings me to another downside of a credit spread is you're risking way more than you're making. Like to make $1,000, I have to risk $10,000, give or take. So it's like, man, I don't lose 10 grand. Now, will you lose 10 grand? Not with my plan. No, you'll lose about 30% of your max loss. So realistically, with my strategy, you're not going to lose much more than 3 grand. So you're still going to lose 3 grand compared to 1K. So how does that work? Well, credit spreads have a 90% win rate. So if you're doing 10 trades and you win on 9 of them, so you make $1,000 on 9, so you're up $9,000, and then you have a losing trade and you lose 3 grand, you're still up 6 grand profit. That's how you're able to risk way more than what you're making. Now, if you do this on a 50-50 win rate, you're screwed. Right? A directional trade, you're going to really struggle because it's got to be flipped, right? You've got to risk 1,000 to make 3,000. All right. Let me. I know. I think you had a question on that. And just says, Tony, my one contract put sell trade has $4,000 loss. The stock dropped from $300 to $24. Should I buy back the put, or is it already at its lowest level? Depends. What's your max loss? If you could still lose another $24 on that. Odds are, if it's gone from 300 to 24, then yeah, just let yourself get put the shares. There's no point of taking the loss at this point, in my opinion. You might as well get put the shares. So only sell puts when you're completely thrilled and happy to buy the shares. Because worst case scenario, you're going to be buying the shares. And will you be down $4,000 once you buy the shares? Yes, but maybe give it a year or 2 and you'll be profitable, right? Brad says, how do you avoid making small wins on 9 credit spreads and giving it all back with 1 loser? And that is such a great point. Brad, the key to credit spreads is you've got to get paid more than 10% of what you're risking. That's the only way the math will work. Such a good question. Remember, with credit spreads, your risk is the same. Whether you get paid $20 to do this spread or $1,000 to do this spread, your risk is the same. In fact, your risk is less if you get paid more. But just for simple terms, your risk is the same. Your risk is the difference between your short and your long strike. Doesn't change. So either you're getting paid $1,000 to do this trade, or you're getting paid $100 to do this trade. But either way, your risk doesn't change. Again, it's better with risk is less with more you're getting paid, but still. Simple terms. Think about it that way. Okay. So you might as well get paid more. The next biggest key point I can help you with that is sell in the right locations. Meaning, if I sold a credit spread right here, it's going to pay me a lot of money, but it's stupid. Because if Amazon keeps going higher, is it bullish? Yes. So do I want to buy puts here? Like, how do I hedge this? No, I don't want to buy puts here. Do I want to buy calls here? No, it's really extended and probably going to pull back. So you're stuck in this like no man's land of, I don't know what to do to fix this problem, except for just pray that this thing doesn't go any higher. Like, that's a crappy strategy. Hope is not a strategy. Okay. So where's a better place to sell a credit spread? How about you sell a credit spread up here off of this resistance? Why? Because if this thing continues to rampage straight up, what's it most likely going to do when it gets to this resistance? It'll probably pull back for a day, at least have a little bearishness. So if I could day trade this and make more money on that day trade and my credit spread is losing, because remember, I have a max loss on that credit spread, I'm going to be down about 30%, give or take, of my max loss. So I'd be down $3,000, so to say. Can I make $3,000 in a day trade? Sure. Boom. And is this a good day trade to have? Yeah. If it's all bull candles right up to resistance, fantastic day trade to go short on. Very, very extended. How do I know that? Because if I was in long, where would I be taking my profits? At the resistance. You think I'm the only one thinking that? No, there's a billion other people thinking the same exact thing that know how to trade. So odds are people are going to take their profits, which means selling, which means a little bit of that. So if you short that you can make your money to get the heck out of that spread. I have options. Now, you could also use this level as a hedge and sell up above it, meaning if we get up above this, it'd be crazy strong. You could buy calls and make money from there to there and offset your spread. So the location is key. If you can sell at the right locations, don't chase money. At the exact same time, you've got to get paid 10%. But that doesn't mean, oh my gosh, I could make $5,000 selling a credit spread here, but I could only make $1,000 selling it there. Don't chase the money. Chase the location. Don't even look at your broker to see how much it pays. Look at the chart first and go, this is where I'm going to sell it. Then go to your broker and say, okay, does it pay me anything at 157? Nope. Okay, I'm not going to do the spread. Don't look at your broker and go, well, it pays me something at 148. Why? Your location was right there. If this was your location, that's the location you would have picked, and that's not a good location. This is where it's at, right there. That makes sense? So the key with credit spreads is realizing that if you can sell in the right place, it's a lot easier to lose small. If you can get paid the right amount, it's a lot easier to put the math in your favor. And if you don't let them lose max loss, get out when you're down 30% of your max loss, which means it's going to be right around your sold strike. That's how you can turn those credit spreads and help you to not blow it up. Because if I were to take a max loss, remember that math that I did earlier, see if I can get my pen to work so it's a little bit cleaner. My pen working at all? Hold on a second. Come on, pen. Do your thing, man. No, it's not really working. If you do 10 credit spreads, you make $1,000 on each one. You do 9 because a 90% win rate, you make $9,000, and then you lose one, you lose max loss, you're down $1,000 over a month of trading. Doesn't make any sense. But if you can, instead of losing $10,000 on that one losing trade, if you only lost $3,000, you are profitable. That's how you can do it. Most people struggle because they don't know how to first off hedge them. They sell for money, not location on the chart, and they just don't know what they're doing. When do you unravel your spreads? I personally don't unravel my spreads. Unraveling your spreads works when you're losing on them badly. But the problem is when you unravel your spreads, you no longer have a max loss. I did that once. I had a max loss of $5,000. I unraveled it to try to make my money back, and I ended up losing almost $18,000. I blew up my entire account on one trade. So it's very important that you understand if you are going to unravel, you need to know what you're doing. You need to have a game plan to manage your risk, because it's much better just to take the dumb loss, take the 40% of your max loss and go make that back in 3 credit spreads or 4 credit spreads than it is to lose 20 grand. Yep. I recommend for all beginners, especially, just never unravel. Stay in it. As long as you're in the spread, you at least know your max loss. You at least know it can't get any worse than that. No, Calvin, I don't have January. I think I did like September, because Amazon is extremely bullish on all time frames. Spy is screaming up. Amazon is extremely bullish on all time frames. So I'm expecting this to pull back and then probably get going again. So I don't need to pay out till July, or I'm sorry, January, because I'm expecting this move to happen within 3 weeks. So give yourself a couple months for that 3-week move to happen, so you don't have to be perfectly right, and move on. All right, let's look at some charts real fast since things are starting to get a little interesting. These alerts are all just alerts I had on my day trade previously that I don't need anymore. All right, so we broke the bear trend right here. Broke it, retested it, rampaged, pulled back. Our higher low was still here, so the bulls are wrong there, and then we started to bounce. If you have no idea what I'm talking about, email me, Tony at reallifetrading.com. Let me show you how to diagnose these markets. So right now, are we bullish or bearish? We are bullish on the 3-minute time frame. Now, the crazy thing is, if you go to a bigger time frame, that doesn't necessarily mean we're bullish. You go to an even bigger time frame, that doesn't necessarily mean we're still bullish, even though the 3-minute is, right? Each time zone is like a domino. You have your 3-minute, your 5-minute, your 15, your 30. This one's got to fall first, and then that one falls, and then that one falls. So it'll go bearish on a 3-minute, it'll go bearish on a 5-minute, it'll go bearish on a 15, on an hour, and then finally bearish on a daily and then on a weekly. So your weekly could still be bullish, even though your hourly is bearish, right? It's just see how the cookie crumbles, so to say. All right, so jumping back here into SPY is making a strong push. But if we go to a 15-minute chart, it broke the, it even broke the bear trend. No, it didn't. Never mind. Never mind. So we are actually still bearish on this. So what are we doing here? If we go to an even bigger time frame, it's easier to see. All these candles, what is this simply doing? What is this move doing right here? We're retesting. So what makes the most sense? Probably a rotation down. Again, breaking these lows for the day. On a 3-minute, this thing looks like, shoot, man, let's go. Buy some calls and let's rock and roll. Could that work? Of course. But what am I looking at? I'm looking at a lot of bear strength all day long today. So I probably don't want to be going bullish. In fact, I'd look for bears to step in, right? And this thing's most likely going to be running over, rolling backward. So did I mess this thing up? I think we're okay. All right. There we go. Okay, it says, I'm a beginner looking for a strategy to paper trade for a year or until I become profitable. Any recommendations or favorite strategies to where to find lessons for those strategies? Yeah. So remember, Kate, if you want to be a successful trader, strategy is just the tool to do it. The strategy does not make you a successful trader. You've got to know how to read the markets. When you know how to read the markets, then you apply whatever strategy you want, right? If I think the markets are going to go up, I can buy shares, I can sell puts, I can buy calls. There's a lot of things I can do to make money as the price goes up. Now I've got to figure out which tool I want. So that'll be my recommendation for you. Don't get stuck on the strategy wheel, because what's going to happen is you're going to realize these strategies, they work and then they don't, and they work and then they don't. You're not going anywhere because you keep going bullish when you should be going bearish. You go bearish when you should be going bullish. You have no idea how to apply that tool, right? I could take a TV to a foreign country, a third world country, and be like, hey, and they'd be like, this TV won't even work. And I'm like, well, have you turned it on? What are you talking about? Turn it? Where's what? There's a power button, right? You don't have electricity. Oh, okay. Yeah. The TV's not going to turn on if you don't have electricity. And that's how a lot of people face it. They go, this strategy doesn't work. When did you do it? I did it right here. Well, why would you do it right there? I don't know. Because it was a hammer. right? So does that make a little bit of sense? Focus on learning price action. So I will show you where to find really a whole bunch of strategies. Go to reallifetraining.com and you have all these free courses right here. Free. These guys. Take these, we'll teach you some strategies in those. You have the 10 EMA strategy. You have all these different strategies that you could use. By the way, we'll also give you some money to trade with it. That's pretty cool. And go that route, right? So what you could also do is this right here, this course, post it. This is my course, how I teach how to read these markets. Again, I'm just going to tell you, master the S-curve. Yes, we have S-curve videos on YouTube. This course with my S-curve is my specific rules to determine what an S-curve is and isn't, and then how do you use that to apply it so you know where to get in. I teach you a strategy using this as well. So do that if you want. Learn it on your own. It doesn't matter. But that's the solution to your problem. Okay, is you've got to know how these markets work. When you know how these markets work, then learn the strategy so you can go to your toolbox and say, okay, I'm going to do this, this, and this. I'm going to do this. I'm going to do this because of that, right? So yes, you do need to know strategy. Just realize that learning strategies out the gate is not necessarily going to get you there. I would say learn the markets. And that'll happen. That's just my 2 cents. But KP, what does unravel a spread mean? It means, remember we talked about earlier, whenever you sell an option and then buy an option, you are now protected because this thing loses if it gets above it, but you have insurance, it means it can't lose above that. If you get rid of your long option or you get rid of your short option, it changes the scenario. You went from I win as long as it stays below this to it has to go higher in order for me to win, or it has to go lower in order for me to win, depending on which one you close out. So it turns it into you have to be perfectly correct now. And if you're not, you're going to get crushed. So yeah, Jose says big candle on SPY, definitely a big candle on SPY. So now we're going to see if these bigger time frames are playing out, because I personally think we're bouncing up to here and it's probably going to roll back down. That's what I see on the markets. I could be dead wrong. If we don't do that, that tells me there's a lot more strength. And so now I got to reevaluate what I'm seeing. But what the markets are telling me right now is that we probably roll back down again. So that'd be my 2 cents. In my opinion, we're still in some bear moves here on like a 15. Can I look at Ford? Of course. Jeff, what about Ford? Is this a day trade, a swing trade, overall, just long-term? Let me know, my friend. Enrico, correct. Yep, the S-curve is handy. By the way, guys, if you're in hosts and panelists only, I can see your message, which is fine. If you go to everyone, then everyone can see your message. But the S-curve works on every single time frame. It's what I use to make my money today. It's what I use to sell my credit spreads. It's what I use to do swing trades. It's the reason why I bought puts on Amazon. It's the reason why I day traded puts on SPY today. It works on everything. It works on long-term investments. You can use this in your IRA. It's the markets. The S-curve is telling you where you're wrong. Right here, the bulls are no longer bullish. So if we pull back, are we still bullish? Yes, we're still bullish until we get below this. So you can use this on a big time frame and go, okay, well, I know the markets are down 20%, but have we taken out any higher lows on a monthly or whatever? So I teach you that. That's fine. Everyone knows this, but there's a whole new twist to it. And I show you how to not only know what's about to happen, but to know where to get in, how to capitalize it, what strategy you use to capitalize on it, how to be a little bit more consistent with it, and what actually makes up a higher low. What's the difference between this higher low and that higher low? Which one do I consider, right? There's specific rules that I go off of. So there's quite a few of them, but it's very, very easy. It's beginner friendly. It's literally the first thing. If you are like brand new to the markets, that's the first thing I would teach you, would be that. So again, my friend, let me know about Ford. Calvin, brother, I already showed them that. I can go over it again though. What time do you place your first trade of the day using the S-curve? It depends on the setup. You're either waiting for the trend to break or you're waiting for the S-curve to tell you it's about to do something. So I let the markets tell me what they're about to do. So don't feel like you have to be in the first 30 seconds. Like today, I think I got in like 15 minutes after the market opened, got out for a small win. And then after like another hour later, I got into another trade when the markets told me, hey, this is about to go down. So. Sorry, my friends, I got a ton. I've done some. Good, Cal. I can go over it then. Again, let me know what you want to know on Ford, by the way. A covered call. Okay, there we go. Saw it. So if we're looking at Ford right now and you're looking at selling a covered call, this is a great time to sell a covered call on Ford. I would go to a weekly chart and I would look at my next real resistance, and that would be up at about 18 is where I would sell a covered call, sell it 30 to 40 days out, wait for this thing to pull back down, and you're ready to rock and roll. That's what I would do. Rajat said, creating a debit spread for an existing call is okay to manage risk. Yeah. Yep. So if you bought a call up here, you make money as the price goes higher. You lose money as the price goes lower. In simple terms, right? There's other things that go into it, but I'm just trying to keep it baby steps. So if you turn this into a debit spread, meaning you sold a call against it, all that means is that you can still make money up to that sold call. But the cool benefit is if it starts to pull down, this thing is now making money. It's not making money as fast as this is losing, but it's still making money. So it slows down. It almost freezes your P&L. It freezes how much money you're losing. You can do that with puts as well. So it kind of locks in whatever price you're already at. So if you're down $200 and you sold a call against it in this scenario, you would stay at that $200, maybe $250 mark for a little while, even though the price has gone down. Still, what's up for us newbies? Can you say what is a call, a put, and an option? Of course. Let's dive into it. And by the way, if I haven't gotten to your question, if you posted it, Slack pane, the chat pane is blowing up. So please post it again. I'm sorry. It's hard for me to catch all the questions because I get on this rant, and by the time I'm done talking, 20 questions have gone by. Okay, so the simplest way to think of a call. A call is, there's a few things that go into this that I'm trying to figure out what is a good way to explain it. Hold on a second. Sorry, pull this thing up. See if I can get my pen to work, because you guys don't want to have me just drag my mouse around. Right? That's no fun. All right, pen's working. We're in business. Okay. If the stock is currently at $30, whoa, pen's not working. You know what? I'll give you a better example. Real world example. If you're looking to buy a house, this is going to be a dang good house. Okay, this house is $500,000. You don't have $500,000 yet, but you'll have it in 3 months. You go to the seller and you're like, hey, homie, I will give you 10 grand if you, come on, Pen, if you agree to sell this house to me for $500,000 and I have 3 months to purchase it. That guy's like, cool, I have no other offers and I'll take your 10 grand because that's free money. And boom, there we go. So you're now in a contract. You are now controlling a $500,000 asset with 10 grand, right? Does that mean you own it? No, but you have the contract and the ability to purchase it for $500,000 for at least 3 months. If after 3 months goes by and you don't purchase it, you don't own the house. You lost your 10 grand, right? So let's say across the street, that's a good street. Across the street is a big empty field and you have two options. Either they're going to build a nice swing set, nice little swing, or they're going to build a waste transfer facility, really stinky, really nasty. You're not sure which one. So you enter this contract to buy the house for $500,000, and a month later, they decide to build the park across the street. This house is now worth $550,000. Jackpot. So you could go ahead and exercise this and purchase this house for $500,000 and immediately be up $50,000 in equity. Or you could turn around to someone else and say, hey, pay me 20 grand and you can own this contract to purchase a house for 500 grand that's worth 550. It costs them 20 grand, but they're still up $50,000 in equity as soon as they do it. So it's valuable, right? So you could turn around, you could flip that, and now you've made 20 grand. Boom, right on. Someone else has a contract to that. What if the scenario flips and they decide to build the waste transfer facility across the street? This house is now worth 450. My pen would work. 450. Well, I can't turn around and sell this contract to someone like, hey, here's a contract to buy a house for 500,000 and it's only worth 450. No one wants that, right? So you could either you could exercise it and you're going to be down $40,000, or you could just lose 10 grand and go, you know, I'm going to walk away from this deal. I lost 10 grand. I could have lost 40. It's all good, right? You see the scenarios on this? So now let's apply this to the markets. The stock is currently at $30 and you buy a call option to purchase it at $35. So if you bought the $35 strike, what the heck does that mean? You have a contract to purchase 100 shares at $35. Now you paid money to enter into this contract. So let's say you paid $200 to purchase this call to enter the contract, the ability to buy the stock at $35. Remember, the price is currently at $30. If the price, and by the way, you have an expiration. So let's say 30 days. You have 30 days to either get out of this or lose your money. It doesn't matter, whichever one, right? Let's say in the first 2 weeks, the price goes all the way up to 30, let's say $40. You could now turn around and sell this option to someone else. You paid $200 for it. It's worth $600 now. So you could turn around and say, hey, someone pay me $600 for this, and you can buy this stock at $35, even though it's at 40. Boom, you've got instant equity in your shares. Scenario number one, that's like the park being built across the street. Scenario number two, instead of the stock going up, the stock goes down. Who's going to buy this contract from you to purchase the stock at $35 when they could just purchase it at the market for $25? That makes sense? So the value of this option, if this pen would work, the value of this option is going down. So you paid $200 for it. You might be able to get someone to pay you $50 for it, but realistically, it's worth nothing. Squat diddly. Right? That makes sense for calls? Cool. Let's talk about puts. Puts are insurance in the markets. So if you have car insurance, you have yourself a nice little car over here. Oh my gosh, that pen does not like that spot. I got to move it over here. If you have car, here's my nice little car. Oh yeah. Pickup truck. Yep. There we go. Sorry. For some reason, it is not happy. I don't know what's going on. It's not that bad. You got yourself a car. This car is worth $40,000. Come on, pen, you can do it. Worth $40,000. And you go, hey, I don't have insurance on this. If I wreck this, I lose $40,000. Or I could spend $200 right now and buy some insurance on it. And if I wreck it or if it gets stolen, I could just put a claim into that insurance and I'm not out 40 grand. In the markets, if let's say you owned $10,000, oh my gosh, come on. Maybe the pen's not worth it. The pen's not worth it. I'll do my mouse. If you owed $10,000 of shares and you're nervous that the stock is about to go down, you could exit your shares, but then you miss the chance of what if the stock keeps going up, right? Or you could simply spend some money. Let's say you spent $400 on insurance. So you spent $400 to insure this $10,000 position. Okay. Stock's at $30. If you bought the $30 strike put, that means your insurance kicks in below your strike on puts. So if you spent, If you bought the $27 strike, that means your insurance doesn't kick in until the stock gets below $27. And then when it does, your puts will offset every dollar that your stock loses once it gets below $27. That makes sense? So do you need to own shares to buy a put? No, you could simply flip it, right? If the stock is at $35 and you think there's a really good chance it's going to get to 30 and you buy the $32 strike insurance, you just purchase the insurance. Lost on the puts. Hopefully this will explain it a little bit more. If you don't own any shares, the current stock's at $35 and you bought the $32 strike put. You bought that for $2. Okay. Say it cost you $2 for the option. Remember, you got to times that by 100 because each contract is for 100 shares. So you just spent $200 on puts. Why are you doing that? You don't own any shares. Why? Because you're hoping that you can flip it to someone else for a profit. If the price goes down to $28, the value of this insurance just went up huge, right? Because if someone owns shares and they're like, frick, it's all the way down to $28, and you say, hey, you have the chance to be able to sell your shares at $32. Someone's going, heck yeah, I want that. So they're willing to pay you $1,000 for that insurance, even though you only paid $200 for it. So you just can flip this. That's what a put is. A put is an option, a contract. Exactly. You're just trading the put itself, and you're using the charts on the stock to determine whether or not that put will have value or not. So if the price goes up higher, this $200 put that you paid insurance for is not going to be making a whole lot of money. That makes sense. And a long put is simply an ability to exit your shares. So if you own a long put at the strike, meaning I could exercise that and just sell my shares at that strike, or I could flip it for cash value and keep my shares. 98% of all options are simply people trying to flip it. Like me this morning, whenever I bought, so here we go, Calvin, I'll go over my SPY day trade. Whenever I bought puts, I didn't own any shares of SPY. So why did I do that? Why? Because we came up into this range here. We broke the higher low. We retested, telling me it's time to go bearish. We bought puts here because I figured the price would go down and I could flip this for someone else, for something else, for more than what I paid for it. Okay. So I bought puts here. I think I paid, oh crap, how much did I pay for those puts? Oh, 87 cents. I paid $87 a put. I bought 20 of them. As it came down to here, I sold those 87-cent puts for $1.55. I almost doubled the value of those options. Almost. Nearly did. I think if I could have got a little bit better fill on this, then I would have. But that was my target. Between these two trades, I doubled my investment. My first trade and my second trade. This trade alone was what nearly did it. Bought it for 80-ish cents, got out of it for $1.55. Boom, shaloom. Flipped it for a profit. That's all options are. That helped, Crystal. Again, if you have more questions, you can email me, Tony@reallifetrading.com. My time is almost up. I'll be on the mic a few more times this week. Calvin says, one last question. How are you so bald, but yet look like you have hair? It's because I don't tilt my head down, Calvin. Gosh, man, let's keep them to trading relating, bro. All right, thanks. From the start of the day, what does it say? What were the higher lows from the start of the day? So I let the markets tell me, right? So we rampaged up, pulled down, went up. Here's my higher low. pulled down, went up. There's my higher low, broke it, chopped, came down, bearish, rotated over. So as soon as we took out this pivot spot, I was like, game time, shorted it, rolled it over. Well, the markets are rolling down. We'll see if this actually follows through, but this is what the charts were telling me about 10 minutes ago that should happen. Will it follow through? I don't know. But I knew not to go long right here. All right, after the SPY put in a nice big old candle, to me was not saying go long. It was opposite, go short. This is a big time candle right here. This is breaking the trend. If it can close below that, we'll see if it does. We should see some volume on this candle. Yep, there we go. Compared to the previous candle or two, that's what I compare my volume to. So still have about 15 seconds left. This is a decent volume spike compared to the last candle. We'll see if this closes. If the bulls buy it up, then there's still a chance that the battleground will continue. But this does look like it's trying to. That's a good buy up. So to me, it's still on a little bull trend here, even though that got really close. But I'm expecting this to continue to roll over. How do you manage expectations with news? What do you mean by that? Do you mean like me trading the news, or the trades I'm already in when the news comes out? How much of your options trading is within intraday? 30% of it. So I don't trade over earnings. And I have a game plan if it breaks certain levels, right? I'm able to look at a market and go, all right, if we pull back to here and it does this, let me go to a daily chart. It's swing trade, right? So I'm expecting these markets to pull back. I am in pretty heavy SPY puts. If we get up above this, I have a game plan of exactly what I'm going to do. So if news comes out and we just gap up to here, it's not like I'm like, oh my gosh, I'm just going to lose. This is the worst thing in the world. I have a game plan of what I'm going to do to make my money so that I can at least lose small, if not turn that into a winner, just like we did on our day trade today, right? We were able to turn a loser into a winner. Is that work? Does that happen every time? No. Did you buy your puts on the SPY that you mentioned last time? I did. I still have one more level to go. If we get up to around 415, I'll buy another set of puts. But I did buy those. Yeah, I am in puts right now. I'll exit one of my legs around 402, and the rest we'll see how low it can go, because I personally feel like the markets are going to get up to about 420 before it goes down. But if it happens now, it happens now. It's fine. Amazon swing trade is looking buttery good. Oh, that's fantastic. Doing exactly what we want it to do. I don't see an alert on that for some reason. Paul O, what expiration for what? The SPY trade? I did the let's see. I'll just give you the one of the strikes I did today. I did the October 21st 396 strike put. I did that today. I have a few other ones out there, but that's the one I did. Again, make sure you understand what your risk is. You're not just throwing it on because Tony's doing it. Remember, Tony, a directional trade, I've got a 60% win rate, which means I lose on nearly half of my trades. This could easily be a loser. And if it is, I'm prepared, right? I'm not losing more than I'm comfortable to lose. And I have a game plan of what to do to help offset that, right? So don't just go, well, Tony's a successful full-time trader. He said to buy puts here, so I'm just going to buy $20,000 in puts, and then it loses, right? How would you hedge the SPY puts if we go higher? I'm not going to be doing a whole lot except for buying more. I have a lot of time on these. That's the reason why I purchased them. You can start looking into selling puts against them. That's step number one. That allows me to still make money if it goes down, which I believe it will. If we do go higher, I'll most likely just day trade it with calls to offset my losses, because nothing has changed sentiment wise. If we go higher, nothing has changed. And by the way, I really do think we'll probably go to 420. Maybe not, but it makes a ton of sense. So much sense. So I'm not going to be doing a whole lot. I've set myself up so that by the time it gets to 420, I'm not going to be losing a whole lot of money. And then from there, I've got to just be patient and give it a week or two and see what price action does. Once price action does something that I can now hedge against, then I'll start putting some hedges on. But for me, I'm going to be patient. So, 420. Nice, Brad. Target on SPY really depends on how fast it happens. Ideally, a really safe target would be like 397 would be a very safe target. Could go way lower. I will be taking some profits off around that area and then seeing how low it goes. Good stuff. Let me see here. So price action going against the news like recently. That's because the news is all jumble mumble fake in the sense that you've got to realize everyone is always behind the 8 ball. Most people on the news have, I'm talking about financial people, right? They really don't know how to trade. They know how to invest or whatever, but they honestly have no idea what they're doing. And most of the time, it's big money trying to either get in or out of shares. So it's true. It's comical. You can look at this statistically every single time. When we're at all-time highs, they're like, this is the greatest time in the world to buy. Is it the greatest time in the world to buy? No, it's the worst time in the world to buy. But why are they saying it's the greatest? Why? Because if you're trying to get out of 50 million shares, you need someone to buy 50 million shares from you. So if you can get a lot of people excited to buy, you're able to get the frick out. And when the markets are down in the dumpsters and falling apart, what are they saying? Sell everything you have. Why are they saying that? Because now they're trying to buy 50 million shares. So they need someone to sell them 50 million shares. That makes sense? So don't pay too much attention to, oh my gosh, they said that the market's going to crash 20%. They don't know. No one knows. Trade the charts, have a game plan, put the math in your favor. Oh my gosh, the stock market's going to go up 100%. They don't know. No one knows. Don't trade off of news. It'll just make you lose money. Learn how to read the charts. Learn how to read sentiment. Learn how to identify and read statistics from the economy, all of these things. So that's my 2 cents on that guy. Dan the man is off next.
Yeah, man. What is happening?
What's up, dude? Dan, we've been having way too much fun in here, man.
I know. What a group we have. But so you're telling me just trading whatever Jim Cramer tells you to trade is not the best strat? Is that what I'm hearing? I don't know.
There's a few strategies out there that could make you more money. That's
some better returns out there. Okay.
There's some better returns out there. That's all it. Right. So yeah, man, we've had a great time hanging out. We talked some options. We learned some options. I did most of my trading this morning, and bro, I'm done for the week, man. Who's that I hear on the mic? It's the world famous Dan Jansen. That's who you're hearing. Yeah. So hit our weekly goals already this Monday, and I'll have some setups on some swing trade stuff, but we'll see what today brings, my friends. Getting close to the end of the day. DJ Dan's in the house. He's going to take you the rest of the way home. Friends, I had a ton of fun. I'm going to bounce out. Got some more appointments and coaching to get to. If you have any questions, Tony@reallifetrading.com is my email. You can email me. I'd love to be able to help you out on your journey. It really is my passion and my joy to help you get there, because everyone can do it. Every single person can do it. Stop being scared of failure and learn from it. So that's it for me. Love you all. I'll see you later this week.
Appreciate it. You want to just bump me to host this way? I'll pass it to.
Oh, done.
Whoever comes in later.
All right. See you guys.
All right, awesome. We'll get this screen up and running. What is up, boys and girls, ladies and gentlemen, day traders, closet swing traders? Hope you guys are having an absolutely fantastic day. Hope you guys are enjoying the free week. If you guys are enjoying the free week so far, I mean, this is day one. If you guys are enjoying it so far, just throw a quick one into the chat pane. Oh my goodness, I guess overwhelmed already. Man, Jeff, who was that? Steve T went with a 7. He did it 7 times. He just added it all together. I love it. Love it. All right, awesome. BEA, beautiful, man. We got the crowd in the house. Sony is here. Dow Jansen. Close. Very. It gets confusing. Tony says, I'm enjoying free week and I'm paying for it. Yeah. I mean, if that's not a testament to to the power of real life trading, it's crazy. The education. I mean, I've been here. So I went in and out for some points just to run the store real quick. Took one trade on NVIDIA. That was my only trade today. I know Jeremy had a couple on Tesla, and I wasn't able to see if Johnny took any. I don't know if he did or not. But let me. I know we're going to talk more about the long-term investing, but before we get to that, as the market's kind of coming to a close, we'll just do a quick screen share. This is the trade that I ended up taking. It was midday. I don't know. I just didn't really see my setup, I guess, early in the day. I'm leaving no power in the iPad. Yeah, 9 hours could drain a battery. Yep, definitely. So, I mean, this is how we learn though. So tomorrow, just make sure we got some fully charged outlets, some plugs, and we're good to go. And we still have an hour and a half. I'm here with you guys for an hour and a half. And then we have the swing room later today. That's going to be from 5 to 6 p.m. And this schedule hasn't changed for free week, by the way. So every single day, it is a full 9-hour day. We cover a lot of classes, a lot of topics. We'll do live trading today, swing trading in the afternoon, setting up how the market looks at the end of the day, which is extremely important because for day trade basis, obviously catching candles, waiting for them to close. But at the end of the day, we have a full new candle. We have a new candle printed in the history of the stock market, and being able to interpret that and use it to your advantage, either for swing trades or for setting up sentiment trades for tomorrow. Those are all very, very key. So this is the trade I took. I took it over here. I got triggered in, I think somewhere on, actually, maybe I got triggered in on this candle. I might've just got wicked in on this candle. But what I was mainly looking for is the fact that the VPOC was moving down. There'll be other times where I'll definitely cover VPOC a lot more. But we started to change direction at this certain point. Volume started coming in. I saw this initial breakdown, retest, and then I saw this green candle come in. I go, if this one breaks, and then we're going to use all that volume for resistance, I'm going to throw my stop somewhere up here. Was my original, was able to kind of walk it down. I got very close to my target. I ended up bailing a little bit too soon, just because I knew I was, even though it still was the right direction, is where I got into this trade. And then also the direction of the last 2 weeks of almost pretty much anything in the stock market has been bullish. So anytime I'm taking a bearish trade within the last 2 weeks, I'm trying to get out. I'm not as willing to hold it as long. So still can't figure out what that indicator is on your left side. The indicator on the left side, and let me take off all of these so it'd be a lot easier. But it's called VPOC. Let me find exactly how it's listed in TradingView for you guys, because they do update the name sometimes, and it has changed. It's the same indicator for me. I have not added anything different, but they do change the name. So it's actually this one over here. It's SVP. If you go to indicators up the top, I believe it's under session volume, something like that. Yep, session volume profile is how it's listed. So you'd be able to add that to your screen. Dan is a very difficult part. Yeah, it takes time. Yep. That's how we get you on free week. We're like, free week. And then at the end, you're like, I still don't quite understand DJ Dan. And now you have to become a member. It's not even about trading. It's just trying to figure out what goes through my brain, I think is really, I think that's, that's the point. But either way, so that was the trade I did. And then this line here is, all this is telling you. So I'll do like a brief 5-minute thing. Normally people look at this volume down here. I do as well, right? This is going to tell you the volume down here tells you the volume traded in a certain time frame, right? So right now I have it on the 5-minute. This volume right here, I believe that represents this candle right here. This was some volume on a bullish candle breaking really into this VPOC, right? But this whole volume represents the amount of volume that came in over a certain period of time based on whatever time frame you have your candles on. The volume over here represents the volume that came in at a certain price, right? So it tells you where people are actually interested in exchanging shares at what price. And that's how you're going to take advantage of the VPOC, because obviously here we had a clear breakdown, right? So there was a lot of institutions shorting the breakdown, pushing this thing down. What do you think happens right when you get back to that price? Do you think institutions honestly are in the game to lose money? Probably not. So as we get into this zone again, guess what they're going to do? They're going to take their extra bags of cash to go, yeah, let's protect the position and let's bring this thing back down short, right? So I didn't play this one over here. I was recording the Pivot podcast at that point. But if I was looking to trade again, guess what area I'd be interested in? Somewhere right around here. Also seeing that volume come in. I mean, always buying as close to VPOC is beneficial, but even if I see that volume coming on this time frame, knowing that I'm trapping those bulls, plus we're also getting rejected by VPOC, so throwing some kind of entry down there would make sense. Or realistically, just throwing some kind of entry somewhere around 185.44, and again, almost do identical trade to what we did before. But I didn't take that one. It's also getting a little late in the day too. Yep. David said, "Is this recording? Will I be able to view this again? I'm at work, so I can't follow 100%. This one is not recorded. We do have other videos on VPOC, and the so only the afternoon room is recorded that we send out to people, just because the information obviously in the afternoon room is going to be more relevant to people that still have time to set up trades, right? So a lot of these things we have classes on. We do cover them pretty much daily. As far as throughout the week, we'll cover probably more topics on some of this stuff. But a lot of the day trading and stuff like that, it's obviously the information is only really relevant to that time frame. And then we're live 9 hours a day, so just the amount of time. I mean, you would need ample amount of time. You'd have to find more than 24 hours a day to be able to listen and absorb a lot of that stuff. But we do have, yep. So Matt is actually sharing a link for you as well. Yep. Still recording from Tony's session. Yeah, awesome. So we're still in there. So as soon as we disconnect with it, I'll just leave it running for right now. But very cool. Yeah, and then again, so that stuff we like the afternoon rooms, you'll automatically get emailed to you. These ones, I think they go into the real life trading recording from however this records, then we'd have to get the link. If you want to email the link of any, if any of the moderators record their session, a lot of times they do it for themselves, but if you guys want it, I mean, we have it. It's just the amount of again, time it takes for somebody to consume that information if they're not specifically asking for it. Typically, we don't really get asked as much for it. But yeah, no worries for sure. All right, so this is the time frame where we are going to be discussing a little bit more on the long-term building wealth section of real life trading, which is absolutely critical to one's financial situation, I can only imagine. But before we start, if you have a long-term portfolio, type a quick 1 in the chat pane. We got a couple of 1s coming in. All right. Ooh, some more stuff floating in now. All right, that's good. Fabulous. Type a quick 2 if you have a long-term position that is not your 401k or related to your job. We got a couple additional 2s. All right, so we got some extra long terms. Beautiful. The difference, obviously, is number one, the 401k is recommended, I would say, if you are getting a match at work, right? Because then it's part of your base, it's part of your salary. So a lot of times when I talk about the long-term portfolio, a lot of people will be like, well, I got the 401k. Terrific, great start, right? I highly recommend it, especially if you're getting the match. If you're no longer working with that company, typically it's best to just roll it into an IRA or something like that, so you can self-manage, you get access to more asset classes, things like that. All right, so just keep that in mind, because they do have management fees and things like that. But if you're getting a match, you're getting free money at work, right? So what I'm really talking about is not so much the 401k. What I'm really talking about is, and it doesn't have to be for retirement. It could be for how to set an account up if you want to buy business. It's how do I set up an account if I want to buy a first-time home, an investment home, anything like that. This is where the account will come into play. Usually when I talk long-term, it's 10 years. So Jose's got the SEP IRA, good for DJs and cool people. There you go. I'm talking minimum 10 years. I want a 10-year time frame. This is actually the best virtual writing I've ever done in my life. So I'm glad you guys are all here to witness it. I'm looking for a 10-year time frame, right? And again, if you're day trading, have a day trading account, an account that you know this account is just for day trading. At the end of every single day, I'm closing that account. If you're swing trading, have a separate account for swing trading than you do day trading. I know some people, it's going to take time to build it, and maybe not everybody is able to have enough liquidity to do a day trade and a separate swing trade account. I get it. Work on it, build it out. Every time you make some profit from day trading, throw a little bit of money into that swing trade account, right? Build it up over time. That's fine. There's nothing wrong with one of the biggest things I think I've seen from people is they come in and they go, we'll look at Jeremy, right? And we'll go, well, yeah, Jeremy is going to make money in the market because he's got a large account. He's got a lot of dollars in his trading accounts. Facts, 1000% true. But did Jeremy always have money in the accounts? No, he started somewhere, right? I started somewhere. I started with that one account, right? And this is why I know it. This is why I know it works. I started with one account and I was like, great, I'm going to day trade. And then I see some great swing trades. I'm going to take a swing trade in there. Oh man, I like the stock now for a long term, and I'm putting my long term. It was one of the worst decisions I've done, trying to keep everything into one account. Worst decision. Maybe you guys are better than me. It's possible. It's most likely true. But what do you think on a down day, right? I mean, we've had the last 7 months in the market going down. If you have a long-term position, every single day your account is red. How do you think that affects your day trading abilities for that day? Number one, just to start there, psychologically, you open up your day trading account, you go, man, I'm down. It could be anything. I'm down $300, right? In a long-term portfolio. As soon as you open up that account, and that's also the very same account that you are day trading, swing trading, everything from, right? You're all of a sudden negative. Realistically, you're day trading, you probably are going to get a little more aggressive, because at the end of the day, you go, man, I want to see this account green. I'm trying to spell aggressive. And then I realized halfway through it's just way too many letters. But you're gonna probably try to either overtrade, force trades, not wait for your best setup. And solely, you could wake up, have a great day, have great sentiment, but your long-term account, so you see that number every single day, and on that day, and it doesn't have to be down 7 months in a row for the market, but even that one day, man, if I could just trade to get even in the account, that's terrific, right? But now you're forcing trades, you're waiting. Like I said, I only took one trade on NVIDIA today. That was it. I didn't see anything else that really fit my plan or I really liked. Was there other opportunities out there? 1000%. Boeing was one, but I have a lot of Boeing in the long term. I know I do. There wasn't a great setup that I really loved, but was there momentum? Sure. Did people make 1.5 hours on AMD? I saw in the Slack. Yeah, 1000%. Did Jeremy make money on Tesla? I believe the second trade he did win. Maybe I think I saw the message. Maybe he sold too soon, but he made money, made up for the first trade. Great, well balanced day, well balanced trade, perfect. Ray says, is there tax implication for moving money from margin account and opening another margin account for swing trading? There's not a tax. No, there's no tax implication depending on where you're getting that first money coming from. So obviously, if you have a, and by the way, if everybody just wants to just double check the chat pane, make sure that you guys are on everyone and not hosting panels. Only I'll be able to see the messages. But yeah, if the first account is coming from like a Roth IRA, right? There could be some kind of tax implications because you're not really supposed to be taking money out of IRAs or Roth IRAs. And actually in a Roth IRA, you can take money out because it's pre-taxed. So the only money you'd get penalized on is profits in a Roth IRA, technically speaking. A regular traditional IRA, there would be tax implications because the money has not been taxed yet, right? If it's a pure, just you have a regular trading account with TD Ameritrade, and it's just a regular, like I said, trading account, no retirement, nothing like that. No, you could definitely open a new account and be able to transfer money. The only thing to be careful of, a lot of times with the same broker, if you were to open, like if you have margin on one account in that broker, you might not be able to, I don't think most places will let you get your second account also on margin. So just know that. So you might have to have a different broker for your swing trade account or something like that. But have the multiple accounts for sure. But otherwise, just tax implication, as long as it's not tied to a traditional retirement account, then typically not to move that, right? But so we talked about the day trade. We talked about the swing trade. What kind of accounts are these? What are these? What is the intention of day trading and swing trading accounts? What is the sole purpose for that? Does anybody know? Ooh, Zach got it. Zach's on fire. Zach says cash flow, 1,000%. This is where you build your income. This is where you're going to build your income. I want to replace my job by day trading. Well, you go to work, you make money. That money goes to pay bills. If you want to quit your job, these accounts, and you want to day trade professionally, your day trade and swing trade accounts are going into that cash flow, right? That's replacing your income. If you want to build wealth, you're going to be long-term investing. You want the long-term account. Tony says, I have 2 margin accounts with interactive brokers. Yeah, you might just depending on how it's set up with them. So like, I think I could do it. I think I could do it with TD Ameritrade, but it would be under 2 different accounts. But as soon as I link them together under the same main account, then that would be the issue. If you have another tax ID number, I believe you could do it. But you'd still, again, you'd have 2 different account numbers technically. I know with TD Ameritrade, I ended up just combining the accounts. So it's just, I click different tabs in the same account. And then with that, they don't let you do the margins. All right. But yeah, there's ways to go about it. But typically, as long as it's on the same account number, I don't believe they'll give you the margin for those. All right. But long-term investing, that's your wealth building, right? That's where you want generational wealth. That's where you want your retirement. That's where you want to, man, I really want to get into investment property, but I don't have money. All right. Well, you're going to need money, right? The best way to get money is time. That's it, right? So you're taking money that you make from day trading, swing trading, your cash flow. You're taking partial money out, a certain percentage every single week, every single month, however you handle your bills. That's where you're going to pay your bills, right? I'm paying my bills from this account. I'm paying my mortgage from this account. I'm paying my rent from this account, my car insurance, my phone bill. I'm taking money out so that I can have extra money to spend. But then every single week or month, I'm also taking money from my profitable day trades and I'm throwing it right into that long-term account. And I usually do it by percentage. At minimum, I do 10%. Right? I do 10% of everything I make. And I put that from my swing trade account and my day trade account into the long-term account. If you right now have everything in a day trade account that you're day trading and swing trading, I'm not even talking about long term. Again, get 2 separate accounts. It will be mind-blowingly different of how you interpret the markets, how you trade the markets, what kind of risk you put in the markets. Very, very different. So the same way, again, when I started, I had 1 account. I was like, man, I don't have enough money to get that second account. Like, how do I do it? I did the same thing, right? So what I did was I said, okay, I know I'm only going to take in this account 1 swing trade at a time. That was my rule, right? When I was first starting, because if I take swing trades and I have 5 swing trades open in my swing trade and day trade account, as soon as the swing trades start to eat the margin, right? So if you have margin in your accounts, all of a sudden you go to day trade and you're like, well, I'm all tied up because of swing trades, and now you can't take that day trade, right? So be very cautious of that. I knew that swing trading, it's going to bring me cash flow, but it's going to be a longer wait period. And for that fact, I wanted to focus more on day trading and get very, very good at day trading as my primary income, because I had to choose, right? That was my situation. And then what I would do is take, great, 20% of what I make from day trading is going to go into my swing trade account, right? Brand new account. So I'm starting to build out that swing trade account, it's a fully separate account. And then I'm still taking 10% from my day trades and throwing that into the long term, right? So I had a plan as far as how I was actually moving money when I made money. A lot of people, they'll trade and not know how much money they need, why they need the money. They're just looking to get rich. I just want to get $1 million today from the market. I hope you guys do. Very, very difficult to do it, especially without a much larger account to do that, right? You have to get pretty lucky on some moves, but it could happen, right? There's trillions of dollars every single day that moves hands in the market. But I had that plan. So 20% funds the swing trade, 10% funds the long term. And then at this time I was still kind of working. So I was able to leave some money to help grow the day trading account a little bit longer. But after I said, okay, I'm going to mainly depend in the markets, then I was taking 50% to pay bills, right? So 50% of whatever I made every single week, take out, pay the bills, automatically transfer 20% of my gains into 20% of my day trade gains into my swing trade account to help grow that. And then I was taking 10% and throwing that to the long term every single week, just consistently like clockwork. How much did I make? Bam, bam, bam. And now I'm using 80% of, at this point, 80% of what I was using, what I was making in the market. That leaves 20% to grow the day trading account. So obviously the day trading account is going to grow a lot slower than if I left everything in there. But I'm also taking money immediately out of the markets. It's my money. I earned it. I studied these charts. I made the risk. I want to get paid for it, and I want to be able to live on the markets. But then guess what happens? Now I have a swing trade account building. So I'm able to take the swing trade. That's my S. I'm taking my swing trade account and I'm saying, great. Now I have another employee. My first employee is the day trade account. My second employee is my swing trade account. So now as this is growing over time, and you don't have to have the same amount in each account or anything like that. Your R's could be different for sure. But now I have the swing trade account. Guess what I'm doing with the swing trade account? I'm taking 50% of my gains here, right? And I am throwing that to bills. I'm taking 10%, putting that to my long term, and then I'm building the rest of the account. And then ultimately, eventually this number drops, right? What I was for my day trade account, because my bills stayed the same. I didn't increase my bills, but now I have, again, 2 employees making me money. You figure out what the appropriate amount of money that you need for your bills are, but I'm still taking 10% into the long term now from my swing trade account, 10% from my day trade account. I'm able now to grow my day trading account a little bit quicker. I'm growing my swing trade account quicker. I have enough money to cover bills, and I've just been doing this exact model for forever, right? The long-term account, again, it could be designed for whatever you want. You could have multiple long-term accounts too, right? Just as long as you're able to fund those accounts and figure out the correct percentage. So now the question is, all right, well, how do I successfully build out a long-term account? Because if I was to take $100,000 right now and throw it into an account, and call that my long term, I would be doing myself a huge, absolutely incredibly horrible decision financially to myself. I would never say I want to put $100,000 into the market this year and deploy it all into the SPY today, which is what a lot of people do. I actually have a friend, I don't know, I flat out just told him he's an idiot. I mean, but I've known him for enough time where I could say that. But I don't know if he had maybe some retirement in the market, something like that. But his I think his uncle passed away and he was wealthy, something like that. And he just got a rather large check. So first thing he did, he had debts, he just took it, paid off his credit card debts. By the way, anything debt-wise, try to clean up the credit cards, obviously. That's going to be a huge downer for you to become a full-time trader if you have a lot of credit card debt, because that amount of debt is eating away at your potential gains, right? The high interest. And what I was doing too, a lot of people go, if you make money from your job, you take money from your trading, whatever the case, pay off your credit cards first. I hate that strategy. I 100% hate it. I get it. I understand it. But the best thing you could do with your money is utilize time. If you're going to work, pay yourself first. Give yourself money first. If you make, I'll just say $1,000 a week from your job, right? Whatever it is, just to give us a number. If you make $1,000 a week from your actual employment and you're working full-time or part-time or whatever the case is, same thing if you're making money in day trading or making money in swing trading, whatever the case, you do want to pay off the credit cards, but you also want to make sure you start that long-term process today, right? I personally found this the hardest thing to do is just dump a whole bunch of money, pay down your credit card bills, right? If I have $20,000 of credit card debt, let's say, and I make $1,000 a week, if I take all of my money, pay the bills first, right? My cell phone, the mortgage or rent or whatever it is, pay my car payments. If I take all that money and I'm left with $200, okay, great. I'm putting $200 directly into here. I reduce my credit card balance by a little bit, but not really because I'm still getting a ton of interest. But what's the worst case? Now I have $0 left. I put nothing toward myself. I just worked really to help pay down credit cards. So what I would still do on any paychecks that I get, still 10% right to long term. Build out that long term because that money sitting in there, especially if you're going with some dividends, you're getting extra shares, you're getting extra percentage. That's going to help grow from day one of you getting into a longer term position, right? I've seen people. So he did the same thing, but he was taking, it was a large amount of money. He took all his money, paid down his credit card debts. Fine. He had a lot of money left over. He also had money to give to the kids, all that stuff. But what did he do? So he had $100,000 left over after paying down credit card debt. He I think he also redid his backyard, put some money aside for his kids. Terrific stuff. But then he took this $100,000. He goes, great, I'm contacting a financial advisor. He gives him all of his money and he throws it into the market. When do you think that happened? That was, I don't know if it was the exact high of the market, but it was in that same week. He put all his money into PLTR. No, they put it into some kind of mutual fund-ish type thing, whatever case. But that was legitimately at the very high of the market. So now he's calling me. He goes, listen, I don't know about this market anymore. I'm down like $20,000 right now. And I go, bro, why'd you put all your money in at one time? The better way to do it, dollar cost average. Figure out and the best thing to do with your long-term investment, because it's not all you're doing is your dollar cost averaging. You still want to find good companies, obviously, that you know what they do. They've been around for a while, especially those companies that are on dips, 30% pullbacks. You want to find the Apples, you want to find the Coca-Colas, you want to find solid companies. I want my long-term portfolio to be as bulletproof as possible, right? So if you go, all right, you know what, based on working, based on how I'm trading, all that stuff, I think I could do, and I always just use this number just because it's simple for me. I say, okay, I want to do $12,000 every single year into the market. It could be absolutely whatever you think that you could contribute every single year. And again, the way you're funding this is, well, either through work or day trading or swing trading, and that's your 10% going into an account. And the reason I use 12,000 is just because, again, math is simple for me at this point. How many months are there in a year? 12, right? So that means, all right, 12 months divided by the 12,000, and I think I could contribute every single year. That's $1,000 a month, right? So now I have $1,000 every single month, and I'm going shopping. That's my budget, right? So it doesn't matter. I mean, I could buy, man, I'm looking at the market. You know what? Boeing was down to $120. All right, I'm going to buy $1,000 worth of Boeing, right? If that's my monthly purchase, you could do half of it into Boeing, half of it to Coca-Cola. Like, it doesn't matter, but your total budget is $1,000 every single month. Buy the companies, buy them when they're on dips, buy them, look at products that you use consistently on a single basis. It's a very easy approach. I guarantee you, not so much that you'll be negative on the approach right away as far as like sentiment wise, but you're obviously not. If I was to take $12,000, I put it into Boeing on Friday, and then Boeing jumps up, great, and now I have more money than if I did the $1,000 approach, right? But what if you're that guy who took all his money and we have no idea where the top of the market is in terms of short term? He's already calling me, should I bail on this market? Like, how much lower do you think it goes? I'm like, I don't know. I have zero idea. But what ends up happening is that he'll go, okay, you know what? I'm going to sell because I'm down $20,000, and that's a lot of money. He had a lot of credit card debt, not a great financial situation, and panic sets in, right? You get that sell. There's 7 months in a row of the market selling. That's historically insane. I don't think that's ever happened, but it could, obviously, right? It could be 12 months of selling. It could be 15. Who knows? I have zero idea. There's a lot going on. There's a lot of moving parts in the economy, especially right now that we're in uncharted water. But all of this, just, I mean, if I'm just starting my portfolio and I put $1,000 in, right? And I buy whatever, it doesn't matter, whatever shares that you want of whatever company you like, fine. What if that stock goes down 20% from where you got in, right? So you went from 1,000, now you have 800 all in the same month. Is that good or bad? I would say I would love it. Man, so the company I liked before, that's on a dip. It's been a good company. Yeah, I'm down $200, but guess what? Next month I have $1,000 again, and I could buy more shares for a lower price, get a better position on that. Zach says discount. I like shopping. Actually, I hate shopping, to be honest. I don't really buy anything. I'm very minimalist. I don't know. That's just me. I just not attracted to things. I think like if it's shiny, I'm like, oh, that's cool. I hope somebody else buys it because I don't want to. Be careful. He could be in the free week. I hope he isn't in the free week, which I hope he's here. But even if he is here in the free week, I've talked to him about this. And he goes, oh yeah, probably right. But again, his focus was not so much his focus was not so much like, how do I actually, which I think is a common mistake for people. They don't really understand money. They don't understand what to do with it. They just know, rich people are in the stock market. Everyone tells me I should do something in the stock market, and he's got a full-time job. He's not a day trader. He's not attempting to read any candles. And for the long-term investment, it's not about getting in the best price. I'm not trying to buy this hammer on the SPY, and I don't know if that's the best price in a week from now. But if I see this hammer, I'm like, okay, that's my entry price. Over the course of 10 years, doesn't matter if you're getting the best price. If you're just starting your portfolio, if you're 5 years in, does it really matter if you're getting the best price? Again, if you have the market where you want them, right? You know you're in this thing and you're not getting shaken out. Does that mean you have to buy the same stock if it goes down to $800? No, maybe there's Meta that's probably on discount. Maybe there's Altria, stock symbol MO. Right now it's like It might have went down a little bit, but still probably around 8% dividends, right? Dividends are huge. So watch, it does, again, your entire portfolio does not have to be dividend based, but inside your brokers is what's called drip, right? It's not usually, maybe some brokers are, and I don't know every single broker out there, but at least for the ones that I know, it's not automatically turned on. Drip is absolutely huge. If you buy something like Altria, which I do think personally is undervalued, it could obviously go lower from here, but right now, 8% dividend. You're seeing other stocks out there that have 6% dividends, 5% dividends. So what drip is, that's the dividend reinvestment program. This is going to be an absolutely huge key to that long-term portfolio, right? So if you have, basically what it does is every single month you get, or every single quarter you get dividends from a stock. They're either going to pay you cash in your portfolio, terrific, or if you have drip turned on, they'll actually take those shares and buy partial shares of the same company. So now if I buy Altria, which is EBO, I think it's roughly probably $44 a share or something like that. Okay, I put $1,000 into that stock. And I was about a week ago, it was about 8.5%. We'll just go with 8%. Every single year, I'm getting 8% dividends, right? So I'm buying $80 worth of shares from my initial $1,000 every single year. Every single quarter, I should say. So every quarter, so this quarter, maybe I get another, I don't know, 10 shares, something like that, whatever it is. Let's say I get 10 more shares. Then the next quarter comes out. Not only am I getting the dividend on the initial $1,000, but I'm also now getting dividends from the dividends that my portfolio just built out itself. And there is, you could go to dividend calculators or compound interest calculators and things like that, that will show you just a drastic change. So again, when I say you're not going to see a crazy move in the first 10 years, after the first 10 years, your account explodes, right? It just, the value of time. So I'm going to use two different lines. So you're something like this over the course of time, right? This is with the drip on, how much your actual account balance of that account is. And oftentimes you'll see a line like this. This is probably what you contribute just over time, right? The difference in actual net wealth from just what you actually put in over the years to how this thing actually performs, especially after 10 years, you'll obviously see a difference from, 5 to 6, 7 years. But it's all about, it's the same thing as day trading. You have a plan for day trading, a well-established, written out plan. You have a system, you know how the money moves from one account to the other. And then you have that long-term portfolio, and you're just doing the same thing every single month. And typically over time, like you could, obviously, if you're working a job, I would hope at some point you get a raise, right? So every year, every couple of years, whatever it is, you get a raise, you make more money. Great. All you're doing is you're still taking 10% and you're throwing it into the account. I still have the same budget as to what I think I could contribute. So in this case, trying to do, what do we say? 12,000 every single year, right? And it could be anything. It could be 6,000. It could be, I mean, maybe some of you guys are like, hey, 30,000, 100,000, whatever it is, based on your actual income, actual, like this, how much you make does not matter. Right. But when somebody sits there, and some of you guys, I can guarantee you, because I know, especially some of you guys in the real life trading community, I know you guys have large accounts. I also know there's other people here in Free Week that are either very young, very new to the stock market, just trying to look for a different lifestyle, different change. And the one thing that they'll do is an absolute excuse. They go, well, I can't really make money in the market because I don't have a large account. Possibly, right? If you have a $10,000 day trading account, it's going to be hard, I would assume, to trade full time. To be a full-time day trader is going to be very, very difficult. And I wish I could say something different, but I can't. Right? If you have a $100,000 account, guess what? The trades that you're taking, the setups are exactly the same. Nothing is different from the setup, the candlesticks, the patterns, how you use the VPOCs, how you use RSI, whatever your trade style is. Nothing changes on the setup from a $10,000 account to a $100,000 account to a $1 million account. Right? Absolutely nothing. The only thing that changes is how much you're risking on the trade, and your risk is based solely on what size your account is. So just over time, the more your day trading account grows, the more money you're able to make. And again, if your bills and you're not changing expenses or anything like that, typically they might go up a little bit, even just with normal inflation, food costs, things like that, gas prices. But for the most part, this thing kind of level. You're still living within the same means. You're not going out and renting yachts, although maybe you do. That's up to you, right? But if you want to build your account out, your income is going up every single year by day trading, swing trading, long-term investing. But typically your bills, for the most part, are staying consistent. You know what you need to live, right? And now you have that extra money. Your account grows quicker. And now eventually, especially if you have that long-term portfolio, and this is what a lot of rich people do. If they're looking to buy a car, they don't take their money that they've made. If they're working, right, and they make, I don't know, $100,000 a year, do you think that they're buying the newest, latest car from the $100,000 that they're making? Probably not. They're keeping that $100,000. They don't want to spend it. What they're doing is they're employing it into investments, the market, business, into real estate, into different things that are going to produce passive income, right? So now that $100,000 is making them another $10,000 a year. They're buying that new car, that new house, the new pool, all that stuff out of the money that their money already just is generating for them. Because now guess what? Yes, now they have the car. They still have the same $100,000 in the account. That hasn't changed. And next year they're getting another 10K in dividends or rental properties, things like that. So that's how people do it. They're not using their initial money in the market to actually fund their life. They're trying to build this out, keep their money, use the money from them investing to buy their expenses, right? So all we're doing with the long term is we're trying to build out that long term to get to substantial amount of money that the dividends coming in, the gains coming in from those stocks, you're living off of, I don't know why I put 20K, but you're living off of that balance, which is providing you passive income every single month. When you're day trading, it's the same thing. You could have $1,000 to start with. Are you going to live off $1,000 and quit your job today? Probably not. But 5 years from now, you might be able to, right? If that's all you have, $1,000 to day trade with. My guess is you probably don't have a long-term account yet. Start it today. I don't care. I don't care how much you have to say, this is what's available. Start today. You'll thank me later. And I would like a handwritten note, but just like, envelope. Thanks, DJ Dan. I'm very humble, very humble. Which is, says my 15-year-old has 2K account and only risks $20 per trade. The 15-year-old is set up correctly. $20 per trade. Beautiful, beautiful. Because you got to start somewhere, right? You can't look at the Jeremys of the world and go, well, yeah, he's at an advantage. He's at an advantage because he started earlier, right? These guys you see on YouTube that are like, oh, I'm a millionaire from trading. They weren't always millionaires. They had to start somewhere. You have to start from day one. You have to do your first push-up before you get all chiseled out, right? You're not just going to be jacked up from one push-up. And if you never do that first push-up, you're never going to get to the gym, right? The heaviest thing in the gym is probably that front door, right? If you can get through that front door, you're in good shape. Like you're already in the right position. Opening that front door and getting there that's the challenge. Once you're inside, you can go to the barbershop, but eventually you're going to get a haircut, right? If you're in the markets long enough, eventually you're going to take a trade. Eventually you're going to see that portfolio. And again, even if the long-term investment is $25 a month, that's it. $25 every single month. because I can guarantee you, once you start seeing results, this number is going to be like, hey, what if I did $50? Can I afford it? I've not really had an issue spending $25 every single month. I think I could do 50. You know what? Maybe I could do 100. You know what? Maybe I could swing 1,000 now. Like I'm getting more money at work. Some of the debt's paid down, all of that. And you're just building this up. But guess what? That first initial $25 is where you start. That first $100 is where you start. Woodshed's daughter is starting with a $2,000 account, $20 trades. Woodshed, you're probably still gonna have to pay for her college. I'm gonna have to break that to you. You're probably still gonna have to pay for that college. But how do you think she's gonna be when she gets there? Probably a little bit more intelligent and a little bit smarter about, number one, how money works, how to utilize money, how not to just spend money on just dumb things. And you're just probably a little bit well off and probably 18,000 steps ahead of most other college kids by the time they get there, right? So just keep that in mind. It's a very simple strategy. And again, as far as the long-term goes, it's not all just Coca-Cola. It's not all just, here's the ones I do like. Coca-Cola. I like Abivai a lot. Does it mean I should buy it now? Probably not. It's already been jacked up. I do like XOM. It's another favorite of mine. But I was buying it. I haven't bought it in a little bit. I was buying it closer to $30 or probably about $40, something like that in that range. Just keep buying. But then I also got some PLTR, like Woodshed's mentioning, right? This is not going to give me dividends, PLTR. This is very, very speculative. But is it okay if I have it in the portfolio? Because this thing one day could be something. It could be absolutely nothing, go to zero. Am I worried about this? No, because you know why? I'm not too heavy. I'm not oversized compared to the rest of the portfolio. These guys will outperform over time. These guys will bring monthly income, passive income every single month to me. So if I have one stock, I got DKNG, right? I'm holding some of that. Will DKNG be anything? I think so. Very speculative. Rock says yes. If not, worst case, always have an exit plan. So mine is just to sell the rest of my shares to Rock. That's it. That's it. If it doesn't work, I'm like, Rock, guess what? I need you to pick up the rest of them. But I got DraftKings in there. I got PLTR. These are speculative. They might not do anything. I also got Boeing in there. Do they have a dividend? They did at one point. And then those rats just cut it. Still like COVID cut. But I got Boeing. That's not paying me dividends. But I think Boeing, just based on the company, the nature of the company, what they do, I think if Boeing goes under, I think the U.S. economy is in a much bigger issue personally. So I like it, especially the lower they go. I'll just keep picking up a couple more shares. And again, whatever your budget is, if it's $1,000, if it's $25. Also, if you, because I did know this, but I kind of forgot. Let's say you have to start at $25 a month, right? For the long term, let's say, obviously you could get some PLTR, you can get some DKNG, but you're probably not going to be able to afford one share of Coca-Cola. You're definitely not going to get one share of Abivai. At these prices, you're not getting one share of XOM. But there is now, which was not available before, but you could, which I'm not a big proponent of Robinhood, but Robinhood, they do have where you could initially just buy partial shares. So you could buy $25 worth of Abivai. You'll still get the dividends based on what you put in. So that was something that I think I just never had, right? It was just not available until recent. Also, there was always commissions. There was also $7 commission fees. Most brokers don't have that anymore. So like if you had $25 and then you're like, okay, I'm going to buy a share. Well, immediately you're down to about $18 worth of that share that you want to buy and hold. And that would just be absolutely brutal for the monthly buys. But especially now in this market where there's brokers, you could buy partial shares yourself. You could buy Tesla if you want. Even with $25, you're just getting $25 worth of Tesla shares. And you can build it up over time. So it's not, things have changed, and I think it's more, there's more advantage now to being able to do that instead of having to be like, okay, I'm going to have to wait until I can get enough money to buy one share of Coca-Cola. Right. So keep in mind, legitimately in this type of market with how things are set up, legitimately you're able to start day one and get your feet wet. right? That's the biggest key issue, is just getting your feet wet. And why, by the way, is drip so important? Because with drip, you get partial shares, right? So the biggest thing of why drip is so important is because you're automatically getting partial shares. So if you have 100 shares of Coca-Cola, right, you build it up, and it could be anything, 50, 12,000, doesn't matter. But let's say you have 100 shares of Coca-Cola and dividend, I don't even know what it is, but let's say it's 4%, right? 4 or 5%, something like that, in that range. If you don't have drip turned on, yes, you're going to get, let's say it's $4 in your account. And that's probably not even the correct, because it's 100 shares, not $100. But whatever it is, you're getting, I don't know, what is it, $50 a share, $60 a share? So whatever, you get it. So let's say it's, I'm just trying to come in below the price. Let's say you get $40 in your account, right, for that year. You could save up, right? You can now get the dollar amount in your account and then say, great, I got $40 or $50, and now I'm going to go buy 1 share of Coca-Cola. You could absolutely do that. The problem is you're killing yourself with the time value. So if I'm able to now get $10 every single quarter from my shares of Coca-Cola, obviously it's not enough to buy 1 share of Coca-Cola, but I'm getting a partial. That partial on the next dividend is now also making extra dividends. Now I got that dividend plus a new one, right? So it's $20, but it's not $20. It's going to be over because that $10 actually got you a little extra. Then the next quarter as well, great, $10, but now you're also making your dividend on the initial $10 plus that original dividend that you had plus that one before, right? And snowballs effects. So it just gets bigger and bigger and bigger, and then eventually you have some shares. My other thing with the long term is I just never sell. I've had at least not for 10 years, right? So I've had debates, I guess, conversations about, just because people have different strategies when it comes to a long term. Mine is very simple. I'm not selling for 10 years. I'll dollar cost average. As the positions get bigger, I'll play puts, or actually probably not puts, but I'll do cover calls on the positions. So this way, if I have, like Tony was probably talking about, if you have 100 shares of something, I could actually sell a call. So let's say the current price of, well, let's just figure it out, actually. Since we're talking Coca-Cola, let's go KO, see the current prices. And let's flip it to a daily chart. Do I buy puts if the market goes into a bear market? You could if you want to. I have nothing against it. I don't really do it from that same account though. So I will protect, like a lot of times I'll buy the puts to protect my long-term position from my swing trade account. Because whatever dollar amount that I'm putting in every single month from a 10%, that's going there. Obviously sometimes I'll build up extra, because even if let's say the number is, let's say your number is $3,000 or $2,000 every single month that you're trying to buy for the long term. Well, you're putting in 10% from what you get from day trades, swing trades, right? And let's say you have a great month and all of a sudden you have, it's a brand new month. This is the 1st of August. Let's say you have $3,000 in the account, right? It doesn't mean you up what you buy that month. You're still buying $2,000 worth. And now you have you have $1,000 left over just sitting there. I don't like to use this money for a put in the same account, because what if next month it's not great, right? And I'll do the same thing with the money I pull off of the bills too. And I think that is one of the keys to being a successful trader, at least for me. At least it helped me balance out everything that I have going on. So if I need $5,000 a month, right? I'm just pulling numbers out of the air, but let's say it's $5,000 a month for mortgage, car payment, telephone, expenses, whatever the case. And I've already predetermined that. I figured that number out. So $5,000, and it's easier to do later because in the beginning, you're just still kind of building and you're like, great, I'm going to get money. And I'm just trying to make it to that 5K mark. But as soon as you get money over it, it's not like, cool, I'm going to go on another vacation, at least not right away. I'm just building it out. So maybe I get $6,000 into that account that I use to pay bills, right? I only need 5. So again, I have $1,000 left over. But that's because I had a great month. Perfect. I've got $1,000 left, but now that's my extra cushion going forward. Right. So now let's say next month, it's a struggle and back and forth. It's just beating a dead horse, and in the market, I'm just trying to make some gains. I don't need as much on the next month to pay bills because I already have that $1,000 cushion. Once it gets to like something stupid and I'm like $15,000 over what I know I need, then I'm like, all right, cool. Now I got some extra money. I'll do 5,000 for whatever vacation or something like that. But I'll just kind of, or throw a little more to the long term or whatever the case. But that's where I don't want to use the money. But the swing trade account. So let's say I have 100 shares of Coca-Cola. In the long-term portfolio, I don't necessarily buy the put to cover the 100 shares of anything, right? What I'll typically do is go, great, it's still in there. I know my plan is dollar cost average. So if this thing comes lower, it's still a good company. I still like it. Terrific. But in my swing trade, I'm like, well, this market looks like it's about to just get onto a big crapshoot and just completely get crushed. So my swing trade, I'll buy one put on the company that I have in the long term, because this way my net worth still stays the same, even though my long term drops. And then I'll make the money here. I don't have to sell. That's the other thing too with the long term, and that's why I don't really do it. Before we get to that, so if I have 100 shares of something and the market is ripping, so right here we have the daily chart. I got 1, 2, 3, 4, 5, 6, 7, 8 days in a row, nonstop bullishness. I could probably look to start selling maybe like the $67, $68, something like that as far as calls go. Even if I don't make that much money from whatever the value is, because Coca-Cola is obviously not that crazy volatility, but I'll make something. Now that long-term account is also providing some kind of income into some additional money into that long-term account, which I'll have for next month. So I'll do that. If I get called away, great, whatever. I'm selling for a profit and it is what it is. Sometimes you get pulled when you sell cover calls, but you're still making money on those cover calls, right? You're still selling for a higher average price than what you've been buying it for. So sometimes I'll do that. Otherwise, in the swing trade account, I'll protect the long term with puts if I'm like, this market is just looking absolutely terrible. Right. So I'll protect it that way. Otherwise, I don't sell. I just don't. When I buy something, I know I'm looking to get in for 10 years. I'm perfectly happy just holding it. Perfectly happy. If it goes lower, I know, great, I'm going to buy it. Probably buy more, dollar cost average. And then the only way that I really sell is if something fundamentally changes with the company. If Coca-Cola comes out, like if Coca-Cola comes out and they go, okay, we got a new CEO and the stock drops, I don't really care too much about the CEO for the long-term perspective, because they're going to come and go. There's going to be different ones. How many different directions are going to take Coca-Cola? Probably not much. I don't really care about that. But if they fundamentally change where they go, Coca-Cola is now selling tires for cars, right? Then I'm like, well, that's not exactly what I invested in. I didn't invest in a tire company. I invested in a drink company. So it's very, very different. But if they try that new Coke thing again, I am out. Yeah, I mean, they come out with a new, they're like, this one's got 1% less sugar. People are like, Coke, okay. 1%? Crazy. It's the new flavor. Same old taste, but 1% less. Like, how'd you figure that out? The team of scientists working on that one. But that's it. That's the only reason I would change fundamentally. So even like I have some INTC, right? And this one is getting clapped right now, right? These guys are down. I did add a couple months ago, again, nothing too crazy based on the overall budget that I have for the month. I did pick up some more shares. The report came out sometime last week. They had earnings and they dropped, I don't know, 11%, 12%, something like that. I don't mind so much about the individual earnings reports, but this one was horrible. So guess what? Does that mean though I'm going to sell? No, I think Intel is going to be fine long term. No problem with that. In fact, I have no problem buying more shares. I just don't think right now is the best time to add in dollar cost average on Intel, just because they spent a lot of money. they spent a lot of money. The only thing that was positive again is they increased the amount of money they allocated toward research development. They still offer dividends. I'll still get the drip. It'll dollar cost average itself at this point. And I'll wait for 1 or 2 quarters in a row where they have start to see some kind of a positive business direction. I wouldn't buy it yet, Tony. Yeah, if you don't have it, I would stay away right now. I need to see a little bit more from me on the company. For the long, again, I'm talking long-term investment. Swing trade, I mean, let's pull up INTC. There will be absolutely a point where I'm like, all right, I'm buying more shares of INTC. I just don't think I'm honestly down that enough yet. Let me go out to a weekly. Realistically, the next spot I'd be looking to buy is probably somewhere around the $31 zone, just on a chart basis, and then probably about $26, $27. Yep. Everything, there's intrinsic value of these companies. The companies that actually do stuff, like if we talk about like the workhorses and things like that, they don't make money. These companies don't make, like Palantir right now doesn't make money. So if I'm buying something speculative like Palantir that does not make money, DraftKings does not make money yet. So the question I ask myself is, well, when are these companies, are these companies designed to not make money? Right? You have famously Jeff Bezos during the internet crash of like, what was that, 2000s? I think Amazon was down to like $6, something like that. And he's like, and I hear this repeated over and over again. It kind of drives me crazy because he's like, which he's right, but you can't apply it to a broad brush. So he's like, well, we don't control the stock. All we're doing is building out the better company for the future. That's all we can focus on, right? And then you obviously know the story of Amazon, where it's now Amazon and the stock is through the roof, right? But that doesn't mean every company is there. So the question is, does the company have a path to profitability? And if so, when is it? Right. So I'll put Palantir, if they become something, if they're able to capitalize, and I do like I kind of like, number one, I love their management. I think management's solid there. It's a very interesting product. It is, if they are successful, they'll be a massive deal, in my opinion. But if not, okay, well, I'm risking not a lot. I'll give it some time. I'll do another add-on if it's still around this range, trading sideways. Maybe I'll pick up another batch in a couple months. That's all possible. But if the one thing investors really like to see, especially institutions, is the company's profitable. So my question is, at this stage, yes, they absolutely, was I buying them at $25, $28? No. I actually started buying them. I got my first batch probably a little too high, probably like $11. But then the second one I got was down at like $8.30. My average price is $10.30 at this point, right? So like right now, I just within the last day or two, I finally flipped to profitability. Again, not crazy. It's not overweight my entire positions of the portfolio, but if they start dipping again, I'll wait for the next report, see what I like. If I like still what they're doing in the company, all right, I'm more than happy to pick some more up. It's speculative. And again, if these guys are anything in the future, terrific. Same thing with DraftKings. When was the last time I added to INTC? I want to say the last time was probably, I want to say about 2 months. I would say it's about 2 months ago, somewhere in that time frame. I think it was the last dollar cost average I did was probably I would say on this dip, more than likely somewhere it was like the $44, $45 range, somewhere in here. And my first one wasn't far off. The first purchase I got was like $47, $48, right? So it was up there. So right now I'm down in the position from my last buyback. I'm not down that incredibly that much. Because again, I hate, this is the worst for me. And sometimes it works out, sometimes it doesn't. I just can't buy there, right? So if the stock looks like this over the long term, right, and we are here, I don't like buying. I will wait this thing out. I want a more severe dip on that company, and I like to buy here. I like to buy as low as I can. This is where a lot of people buy because momentum is there. They're coming in and they're like, all right, this thing is just going to keep going up. There's always a dip. Even Apple dropped 20% over the like 8 different times during the course of the history of the Apple stock. Companies will dip. CRM is another one. I love CRM. I don't even know what the current price is. I haven't looked in a while. The only thing that keeps me away from these guys, which is not bad. I mean, usually when you pay dividends, it's because you're kind of out of ideas. Like if you're paying dividends, you're trying to provide value for your stockholders, right? You getting a dividend is providing you some kind of value. A lot of times, tech companies, they won't do it. Newer companies won't do it. It's because they could now take that money, and that money is better off, at least in their perspective, to reinvest in the company and grow the company, and there's still more growth to happen. Coca-Cola, there's only so much you could do. There's only so many probably bottles of Coke you could sell. There's only so many new flavors you come out with. Eventually you're just holding money and you're not able to utilize it. So the only thing you could do is buy back shares with it and increase value that way for your shareholders, or produce some kind of dividend. Coca-Cola does both, right? CRM, like I said, a lot of tech companies, CRM is one of them. I love the business model as far as what they have. I think they're essential to businesses for what they provide. They're a little bit, I think, on the pricier side, which is not a huge selling point for CRM, but I have zero issues buying like this dip, right? Buying it preferably closer to 161 was a much better price. That's just where the volume is, but maybe wait for another little pullback, a double bottom, something like that. Start to buy a couple of shares of CRM. Could it get back down to $76 a share? 77? Absolutely. But next month, I don't have to be the first one to buy again. I could wait 6 months. I've literally got infinity amount of time. The only thing that's going against me is my life expectancy. That's about it, right? So when I die, I can't continue to dollar cost average. Other than that, until that happens, I literally have for the rest of my life to build out positions, get better pricing. This indicator is the same thing as the VPOC, but this one's actually under Lux. The company's called Lux Algo. So this is not a free trading view app, so it does cost money. But it's a volume profile, but it's just giving you a longer time perspective. So I'll use this a lot just for I know mainly where institutional investors are. Mm-hmm. So I'll use that. And let's actually pull that up real quick. We still got some time. So let's go to give me a stock. Kaylin. Did I say that name right? Kaylin? I think so. Sounds good if it is. Let's do this one actually. Let's do Bitcoin. It's because I look at stocks too much, but let's look at Bitcoin. Just get an idea of, and again, who knows if crypto ever works out. We gotta go to the daily. And we'll zoom in a little bit. So again, the side volume is just institutional. For the most part, it's volume in general, but a lot of the volume, especially in the stock market, like out of all the transactions that happen, retail traders like us, we're only about 3% of actual volume in the market. All the rest is institutions. So that's why you see big spikes, because that's when institutions are looking to buy or protect positions. So right now in Bitcoin, and we've been seeing some bullishness. We've also seen it in the overall market. But you're probably right around here. We're going to face some kind of potential, like this would be a good spot where you might start seeing a little bit of selling up in this range. But if we get above I would say probably 24,250, let's say, right? Just random number, but very close to it. Somewhere in that zone. There's zero interest from institutions in this range, right? So there's not a lot that they really care about in this range. So that means there's not a lot of people trying to push this thing down from that range. That gives me the next target of where you probably have more institutions that were either shortened or having some kind of area of engagement around here that would probably take us, I think, the next target for Bitcoin. If we get a little bit higher, we'll probably be just over 29,000, somewhere in the 29,000 range. And then we'll go from there, see if it gets rejected or whatever the case. Yeah, I like, Chris, that's a good point. There are ETFs too. I do own some ETFs. Just there's a difference. So ETFs, they're going to give you, like, I love them in certain industries, especially newer industries, like sports betting, things like that. So like you could get Bets, BETZ, which is a ETF to cover a lot of like the sports betting stuff, right? Again, try not to buy it at the high. So when I got in, it was like $15. I was up like 120%, something like that at one point. But so the ETF, it's going to work. It's more targeted, but it's going to work more like a mutual fund where you get exposure to a lot of different companies. And then usually within the ETF, if those companies pay dividends, things like that, you'll be able to collect the dividends as well. Just be careful. A lot of ETFs, they do have fees involved. And that's one of the big differences. If I like that industry in general, the benefit to me is I don't have to just focus on one company, right? And let's say I just bet on the wrong horse and MGM or whoever else just takes off and they're the leader in the market. By at least having some of those ETFs, you get more broad coverage of those. But you're probably also paying the ETF fees and things like that. That's going to take away from the overall return. But I do like it. SPY is definitely one of them. SPY, you could definitely pick up the SPY. Everybody's trying to beat the market, right? That's how hedge funds paint their picture of success. They go, I beat the market by 2% this year. We're a solid fund. If everyone's just kind of competing with the market, why don't you just buy the market? I have zero issues buying and holding SPY, especially on these dips. I don't know that this is the low of the market, by the way, either, guys. Do I care on a long-term investment strategy? Not really. Like I kind of hope this one keeps coming down. Like I don't have to retire tomorrow, so I'm good. And I don't want to see the overall economy collapse either. But there's just a lot. I mean, we printed 80% of the money currency in the market in the last 2.5 years. We also have a potential issue with China that nobody's talking about coming out, which we might start hearing this week. Who knows? Like if not to go political, but if Pelosi goes to Taiwan, I don't think China's going to be very happy about that. And I think they're going to try in some sense, it doesn't have to be war or anything like that, but there's a lot that China has the ability to do as some kind of repercussion from Pelosi visiting Taiwan. Whether they start devaluing the dollar, whether they interrupt some of the supply chains that we're already having some kind of issues with, there's a lot that they could do that's not exactly like, hey, we're going to war. But I think overall that, and we should find out, I think sometime this week. So I'm kind of just waiting it out to see if we hear any news, whatever. But like the media is not covering it as much as they probably should. And the markets are reactive in certain situations. So I think the China play is probably going to be one of the next big plays that we start to hear about. And that could cause another leg down or further just stress on the entire market. So is this the bottom of the market? It could be. I mean, honestly, who knows? I think Tony said it best, like nobody knows, but I mean, inflation is still at 40-year highs. Did that go down yet? I don't think so. They keep claiming the jobs report is like, well, we're not in a recession. We're going to redefine the terms. they're pointing to the job numbers. The job numbers ultimately are more lagging on the economy than they are forward looking. So usually what happens is you go into a recession and then you have the employers go, and we've already seen a lot of layoffs happening already, but then you have employers go, okay, well, we have to tighten up our spending. We're going to either freeze hiring or we have to start laying off people. And then, so usually once the recession happens, then you get the layoffs, right? So it's a lagging indicator, not a leading. So I think there's still a lot of issues in the economy overall. And I'm not trying to paint pictures of doom and gloom because again, this is the bottom, we just rip up higher. But I think there's a lot still out there that we haven't really processed and gone through in just my view. Does that stop me from investing today in the stock market? No, 0% chance. It's just, so today is August 1st, right? Beginning of the month. I have already in the account the money I need for my budget. Does that mean I have to use it today? Can I wait for the rest of the month? Can we try to see a little pullback first? Maybe then I deploy it. Yeah. Do I have to do it every single month? If I'm like, this economy looks like it's getting horrible. No, try not to make it a habit of just skipping months. It's not that I skip it, the money's still in the account, and then next month I just have 2 deposits. So I'm just getting a fatter deposit to make a play if that's my or if that's my outlook on the economy. So just there's things you can do to manipulate. It doesn't have to be like, okay, August 1st, I'm all in, right? Just you got plenty of time. How do you put the volume bar on the left? You must be talking about this thing. This one's only if you have the algo one, the Lux algo. But even in that, I'm sure you go into the settings and it's just left or right. If you have this one, if you're talking about the session profile one, I believe you just go into inputs. Oh, there we go. So placement, and then you just go left. It's the same thing. If you have this one, I think I could change it to the right and stuff like that as well. Tony says, what's the percentage split of your accounts between long-term day trade, swing trade, etc.? What's the max percentage of your account on a single long-term position? I actually don't know if I know those numbers, to be honest, Tony. I know the biggest plays that I have are still all kind of balanced out with the other. So like I have some positions in there that are just in there. Like overstock I have that's just in the account. I might do an ad one day if I see any kind of momentum, something like that. I've got PLTR, definitely not the largest position in my account. But like I would say Boeing, Altria, I guess Coca-Cola is probably close. But they're all relatively, like I don't let them get like, it's not like one is like 100,000 and the others are all 10,000. So they're kind of weighted in that direction, if that makes sense. And I mean, and also, like I said too, you don't need, like, it doesn't really matter, honestly, where your day trade and swing trade are at relative to each other. If they're very close, and if you have the ability to go, okay, I have 50,000 I'm going to do for day trading account, and then I'm just going to fund a $50,000 swing trade account. Terrific. Your R is probably about the same, right? But if you have a $50,000 account that encompasses everything, and you just want to start but you don't have a swing trade account yet, what you could do is just go, great. Your R is probably whatever, $500, something like that, right? And you're taking 10% each week. So you're taking 10% of your gains. So maybe you're up 2K that week, right? And you go, great. I'm just going to take, I mean, it depends on your other bills and things like that. Figure out the percentage for yourself. But let's say you want to go 10% into swing trading, or you're saying, hey, I'm just starting to build this thing. I want to take 20% from my gains. All right, great. Then you go $400, right? Could I take technically a swing trade with $400? Yeah. Is it going to make me crazy wealthy? No. Obviously, my R is not going to be the same. My R is probably going to be a lot less on the swing trade that I'm using from this account. But then the next week, I'm still making money from my day trading. Great. And then next week, maybe I got $800, right? And my R could keep kind of increasing with just the amount. And just over time, the accounts will be kind of balancing out a little bit more. and then you can determine where you want your R's to be. So like you could have a $500 R in your day trading account, and you could have a $10 R because your swing trade account is just building. It doesn't matter. It's the fact that there's progress happening. You're making progress in the account, and you're still doing the same exact thing you were doing before. But eventually this swing trade account grows to a sizable amount where now the swing trade account is meaningful, your day trading account is sizable, and both of them are employees going to work and they're funding that long-term account. They're both helping to pay bills. They're both covering it. And also, by the way, when you have multiple accounts, your stress level is reduced highly, right? So if all I have is my day trade account and that's 25,000, right? And I want to get this account to be sizable because I got to also pay bills. I got to do a lot of stuff. How much stress do you think this will provide you, knowing that that's your only account? You really need to have consistently good days, good months, good weeks. And then not only that, but it's 25K. So it's not, I mean, it's good money, but it's not a crazy amount that maybe that is the amount you need to quit your day job, right? So you're under stress. I need to make trades. You're going to probably be under the stress of you're going to attach yourself to the value of that dollar, right? And then what happens is you're forcing trades. You're finding not the greatest setups. You're also going slightly positive on trades. Like, great, I'm up $100, I'm going to bail, right? And you're not letting those trades really play out. So you're taking money too soon. But then guess what? When you're in that losing trade because you forced the trade, you would only get into a trade, honestly, if you think it's going to work. And you really need this trade to turn around and work. And don't worry, it's coming back. And you're probably going to take a full R loss. So you're probably going to lose your, whatever your R is, $250. But as soon as you saw the trade that you were in start to tick green, you're going to bail more quickly at this. So great, you sat there for a bigger loss and you left at a much smaller gain. And over time, there's a big no-no. Your P&L will be hurting long term, right? So be careful of doing that. But by starting, and again, you don't have to have money today. You will have money at some point. Just follow the process, do what you do. Those accounts will start to grow to very sizable accounts. And then guess what? Someone's gonna be looking at you like, well, yeah, it's unfair advantage because you got more money in the account. Yeah, true. But guess what? It's because you started quicker. You started putting the plan together sooner, right? But how much less stressful now? You have 25,000 in this account, and then you have 25,000 in your swinger account. And you're waiting, you're being patient. You find an absolutely great trade, but you lose. So you're down $250. Okay. But guess what? You have your swing trade account going for you too. Do you have to now jump in and find another trade, or could you just be patient, wait for your correct setup, be like a sniper out there in the market and take it? Yeah, this doesn't bother you because you're not depending solely on this, because guess what? You have another employee. You got that swing trade employee, and he's out there, and you got two trades set up, and they're doing good, right? You're moving stops, you're protecting risk, and eventually it just gets easier and easier. It's less stressful. It's not focused on what you're able to make. It's focused on what you're about to lose or could lose on a trade, right? If you're protecting your risk on both accounts, that's where Jeremy, I think he said it this morning, you don't have to trade every single day to make money every single month. Guess what? You don't have to. I can sit there, watch the market all day, not take a single day trade. I took one today. I've traded full time. I took one trade today. I think I made a 0.8 Rs, something like that on the trade. Is that overall trade going to pay all my bills for the month? No, but it got me into a pretty solid direction for the first day of the week. And that's the only trade that I saw. That's the only trade I had time for. Terrific. But guess what? My long term was kicking butt today, right? So my net worth went up a lot. And I wasn't stressed to sit there all day and have to force trades. Justin says, hold on, I think I missed someone's message. Jess says, is a changing world order by Ray Dalio a good reflection on what you feel could happen? In some sense, I feel like in some sense, I feel like yes, but I also don't want to I don't want to scare people out of the markets, right? I don't think that's the right decision. If the entire markets go to zero, there's a much bigger problem in the world than like you could probably care less about your long-term position because the entire market went to zero. I think we were in some deep doo-doo at that point, right? So to some extent, yes, I think in some sense, I first of all, I like Ray Dalio. I think he's got a good head on his shoulders. Do I think we're at the new world order point? Not necessarily, but I do think I think there has to be changes. You can't sit at all-time inflation. You can't just keep printing money. We have a inflation reduction bill coming out that is supposed to solve inflation by spending more money. So some things don't make sense, right? So eventually there's going to be some new balances, but it's all about how you set yourself up today that affects how you live tomorrow, right? So it's either you fall victim and I mean, where are you going to put your money right now? Cash, and then it gets eaten up. Your buying power gets eaten up by inflation, right? But you got to do something. You got to have money out there working. You got to keep focused on what you do, because a lot of times the broader overall macro scenarios that worry people, you don't have any control of. You can only control what you can do yourself, if that helps. So I think it's good to accept all sides of points of views, understand what's going on in the bigger picture, but be able to plan for it, be able to have a strategy in place. Most of the time during recessions and just overall pullbacks in the market, that's the greatest opportunity people have to become wealthy. But you have to be ready for it. You have to have cash available. You have to have investments available, already set up in place, plans in place. Because when recessions happen and people are afraid of the markets, that's when new millionaires are created. That's when you guys, if you're set up correctly, waiting for it to happen, being aware that's going to happen, that's where you're set up to really make the next big move in your financial situation.
Strong facts, Dan Jansen.
You know, can't be worried. Can't be worried.
You're just over there, just speaking truth.
Follow the plan. That's all you can do.
That's it, man. That is it. Well, thank you so much for doing that for all of us. Type in a 4 if you enjoyed some awesome extra perspective from your boy, Dan, the man, Jansen. All right. There's all the 4s. I love it.
Appreciate it. You guys are awesome. I can't wait. I mean, we're not even done with day one. You guys are, if you have not seen the swing room with Jeremy Newsom, it's a treat. But then we got 4 more days of this. We got 4 more days. That's crazy. I love it.
You know, team, I'm going to share a story about Dan after we begin. So stay tuned for that. Let me stop the recording and start a new one just for a moment.